higher inflation expectations. Look, we're all seeing inflation coming down, but when I look at my one-year break-evens this morning on my Bloomberg, I see 1.56%. To me, that is too low. If I think of the risk to inflation, it's not to the downside, it's to the upside. And Jonathan, you nailed the reason. It's the commodities, oil prices being up quietly 20%. You need energy to produce goods and services. And I think sometimes we underestimate the impact on even core inflation of higher energy prices. So I'm not saying inflation's coming back to the levels we've seen, a year ago, a year and a half ago. But to me, I look at this and the risk is to the upside, and that's what the bond market, even in the long end, is starting to smell.
Sebastian, and for radio, this is my most important chart right now. It's a Bloomberg total return chart. This is the all-in soup to nuts chart as well. And the bottom line here is we're about ready to break down to new price weakness off the carnage of 2 or 3 years ago. And I just don't know what to say here about price down. If we get the bond market to break down to lower prices, what does that do to equities?
It's always a risk to equities because you're revaluing, and year-to-date equities have rallied on the price-earnings ratio and the valuation, and that is sensitive to rates, and earnings are kind of soft, down 7% year over year. So it is a risk to equities, Tom. But one thing I want to say is this is not the time to panic about duration. If anything, now you have a better entry point. In our fixed income portfolios, we have added duration this year. It is a quote-unquote, and I use quotation marks, hedge against a real growth shock. We know that the most anticipated recession in history is becoming the most delayed recession in history, but there's pressure building in the system. So here's what we're doing in our fixed income portfolios. We're not panicking about duration right now. I think we have duration, and we're pairing it with credit. I call this the magic barbell, but I'm getting 9% total yield out of high yield. So I like my fixed income factors to be diversified, and now you get paid. You get paid for the protection of treasuries if you get a growth shock. It won't protect you for an inflation shock, which is kind of, we're not talking about an inflation shock, but inflation pressures, which is kind of what you're seeing now. But I think you have to step back and look at what's the greater risk right now is, sell-off in stocks.
Okay, well, hold on a second. Let me try to make sure that I understand this. You're saying that the risk with inflation is an upside surprise, that it could reaccelerate, and yet you're leaning into duration because it's not an inflation shock. It's just an inflation grind higher. What is the difference?
So we're using duration as a hedge to a growth shock. We're not going fully overweight duration. To me, the risk to inflation is 3-6 months, it starts peaking back up. But at the end of the day, if you take a 6 to 18-month horizon, so Lisa, it's a difference in horizon here, you do want some hedges in your portfolio. And where do you get those hedges? Right now, you get them a little cheaper than you have in the past. So it's nuanced, right? It's just diversifying the different risk factors.
And one thing that you talked about was the commodities pressure to really fuel some of the reinflation. And this comes as we take a look at China and the potential threats there, the risks to growth. If, let's say, there is a reversal in oil prices and that comes with a lot of weakness, how do you rearrange at a time where you're preferring high-yield bonds over equities, where you're preferring sort of some barbell approach to really being a more conservative kind of asset allocator right now?
Yeah, look at the spread for high yield. It's not particularly attractive, although if you adjust it for forecasted default risks, it's not bad. But I'm an asset allocator. I really care about the total yield. And Lisa, the comparison with the earnings yield is really advantageous, 80th, 90th percentile in favor of high yield bonds. I'm getting 9% out of high yield bonds globally, and the earnings yield is down to, say, 5% on stocks. That spread right now is really advantageous. We're not forecasting a really hard landing wave of defaults, even if things slow down in China, which they are. So on a relative basis, look, we always invested in stocks, but we're close to neutral right now, slightly underweight.
Right.
If we're going to add to the portfolio on the risk side, might as well do it with high yield.
Sebastian, very quickly, your acclaimed book, which is, folks, I can't say enough about this effort by Sebastian Page, a really sophisticated effort. Do I want to be diversified, or do I want to be more acutely focused right now?
Look, I think diversification remains critically important when you're going through a regime shift, Tom, which is what we're going through. You've talked about this on the show. Gravity is back in financial markets. We have a ton of cash in the sidelines, so you don't want to go all the way to cash, right, and just miss the upside of stocks in the long run. I don't think you want to go all the way to stocks right now. And there are other opportunities. Look, Tom, let's just think about valuations. Okay, the tech sector is trading at a price-earnings ratio of 30. So let's say you missed the rally. Do you want to chase that momentum or maybe wait to buy the dip? You actually have a third option, which speaks to diversification, which is to get in parts of the markets that have really not participated. Quality small caps, price earnings ratio of 13, that's hard recession level. Emerging market stocks, price earnings ratio at 11. We mentioned high yield bonds, yields at 9%. So the energy sector trading at 12 PE ratio. So there are ways to get in the market where you're not just chasing the momentum. And I call this the third option. Either you chase the momentum, wait for the dip, or take a diversified approach to your question, Tom, and get in parts of the market that haven't participated. Energy, EM, very high yield, higher yield in the high yield bond space. So there are opportunities to get in, Tom, and diversify.
Sebastian, always enjoy your insights, sir. Good friend of this program, Sebastian Page there of T. Rowe Price. If you're just tuning into this program, welcome. Welcome to this program and good morning to you. In the equity market, we're positive here by 0.2%. I can't think of two bigger stories in financial markets right now. The commodity market, one, the bond market, two, Sebastian Page connecting both. Your 10-year at 415, crude at 83, a 30 basis point move over the last 3 weeks on a 10-year yield, Lisa, and a big rally in crude off the lows from the middle of June.
This has been the sleeper issue. I mean, honestly, I was driving around yesterday and I saw the price of gasoline, and you have to start to realize, wait a second, we've reset back to places where people started to push back and get concerned. We're not talking about that anymore because of the resilience, but at what point does that really start to hamper consumer discretionary buying power? Does it also cause prices to go up at places? I'm thinking of airline tickets. I mean, people are talking about prices coming down. Can they continue to go down if you see oil prices where they are?
Airline experts George Ferguson, Bloomberg Intelligence, and others are saying, yes, jet fuel will fold into this if we break out to $90 Brent crude. But I take your point. What I would suggest, not only here, but at Jackson Hole, if you get a continued move up in gasoline, a gallon of gas, it's going to affect the dialogue of Jerome Powell.
You think so?
Yeah.
Shifts that fast?
Got to. Yeah.
Upside risk to inflation?
Even if it doesn't matter, it doesn't matter. In Washington, a gallon of gas matters.
Will he be on the same page as Sebastian Page?
Doesn't have a choice.
Perhaps unlikely at this point, given the disinflationary trends we've seen over the last couple of months. But there's a feeling, Lisa, that they embrace that a little bit in a week or so.
I'm expecting to hear something a little bit more dovish. Patience, this idea of we need to see where we are. We're restrictive, sufficiently restrictive. All of these types of comments.
Imagine if Jim Bianco was on the committee right now. I think inflation's bottoming. It's going to accelerate.
He'd be raising hell.
That'd change the conversation.
Be kind of fun.
From New York City, this is Bloomberg.
trillion industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
I've told you many times, I said it again at the Iowa State Fair.
Right.
I had no right to overturn the election. Look, there's almost no idea more un-American than the idea that any one person could choose which votes to count for President of the United States. The American people know, as I heard from dozens of people at the Iowa State Fair, Chuck, the American people know the presidency belongs to them alone, and no one person has ever had that authority or ever should under our system.
That was Mike Pence there, the Republican presidential candidate and former vice president on NBC, maintaining that President Trump asked him to help overturn the 2020 presidential election. Quite a week ahead for you on the economic side of things. Retail sales tomorrow morning, plenty of earnings. Home Depot in the next 24 hours. Onto Wednesday, you hear from Target. Onto Thursday, you'll hear from Walmart. Going through this morning, equity's doing okay. It's a grind higher on the S&P 500 after a couple of weeks of losses. We're up here by 0.2% in the bond market, Tom. Yields have been higher over the last month or so. They're just about unchanged this morning at 414.83.
On the bond market, we've been talking yield and price. I want to go to this chart. Lisa knows this chart. The Bloomberg Total Return Index. This aggregates in all the bills, the bonds, and in between the notes that are out there. And Lisa, it's just really simple. On price, back to 2001, we had this horrific bond bear market. And then we've had some stasis. And to me, the maximum stress, Lisa, is if we roll over and revisit the price lows on bonds. I don't think that's in the market right now.
So there's a distinction between people looking at their 401ks, looking at their statements and saying, oh my goodness, my bonds yet again are losing a lot of value, versus what we just heard from Sebastian Page, which is yields are high, they look good, it's a great entry point. And that divergence, I think, is unclear in terms of flows.
And something new back 20 years. It was good to speak. Bloomberg speaking with Bill Gross here, I believe it was on Friday here, about some of the history of the great moderation and the great bond losses we've seen recently. Speaking of an immoderate Capitol Hill, Henrietta Trace joins now, Economic Policy Research Director of Ada Partners, who was on fire last week. We had to drag her back here this morning to talk about exactly where we are. Henrietta, it's a broad statement. Is the debt debate now the same old you've heard for years? Or is there something new about our worry of our debt and our deficit?
I had a really interesting conversation with some senior counsel on the Hill late last week that I would share with y'all. The conversation around the debt and a government shutdown and federal spending has obviously been with us for a couple of months now, since the Republicans came into control of the House, and that's great. You want to see that conversation, but the tension that we see between a small faction of House Republicans and the moderate or sort of middle ground of the House caucus and certainly the Senate is so far apart that the dialogue on the Hill now is not about reducing federal spending as a way to get over this impasse that we're going to face at the end of September. It's about who can we impeach? Can we get money for the border? What do we need to do to draw attention to immigration? And it is a dialogue that is really markedly important for your exact question, because it's not about the debt. It's not about deficit spending. It's about whatever they can get from a political perspective to score a win.
If there are tea leaves out there, like something at a state fair, okay, fine, Iowa, or name another state, or if it's something like the vote in Ohio last week that we talked about last week, is there a point where the middle ground of the two parties put the extremes in their place and we move forward to some kind of true political discourse?
I don't think we're going to see that until we get into the general election, and probably not if Donald Trump is at the top of the ticket on the Republican side. The opportunity for Democrats to stress the extremism of the right when it comes to abortion and the inability to move beyond it from the right during primary season means at least for the next 6 to 8 months, we're going to be in these hyper-partisan camps. And the issue of abortion, as you suggest from Ohio last week, is so telling. It moves not just Democratic voters to get out, but the pendulum swing that we see from Republican voters, just for example, in Arizona, is a 4 percentage point swing of the voter base from 2016 when they elected Trump to 2020 when they elected Biden, and then the 2022 midterms. That is abortion. It has moved the needle so substantially that in tight margin states like Ohio, not Ohio, but Arizona, Pennsylvania, Georgia, Nevada, in those states, the margin is so razor thin, but the pendulum swing that you're suggesting as they turn from partisan politics towards the moderate center is really the tell. And that's where you see the shift from Republican voters, independent voters, 63% of whom, or 70 even in some cases, believe that abortion should be legalized. This is a voter issue that has tremendous impact in red states and blue. Ohio would be a perfect example, in Kansas last year.
First debate, 9 days away. Let's set the stage.
Really?
Who's on it?
That's a great question. I don't know that Trump's going to be on it. I think that based off of how he's treating these indictments, he clearly wants to be at center stage. So it looks to me a little bit like he should be there. I would recommend, if I was on his campaign, not to go, because his next closest competitor, Ron DeSantis, is the one to beat. He's at about 15% in the polls, which makes him far and away the front runner of the sort of second tier candidates. Everybody else is locked in sort of those low single digits. So I would say to Trump, stay home if you can avoid the spotlight. Let Ron DeSantis take the last couple of hits. The potential for the Gavin Newsom, Ron DeSantis debate in November 8th to be canceled if this can't be pulled off is something that I think is really important to watch. And Lisa, to the conversation we had last week, it really opens the door for another candidate that maybe is not in the race right now to jump in.
And that's something a lot of people are looking for. When you talk about Trump being a conventional candidate, he is not, as we all know, and he probably isn't listening to conventional advice at a time where he stopped by the Iowa State Fair, broke with convention pretty directly. He wasn't supposed to be there, and he did this to try to basically lambast his opponent, Ron DeSantis, and people applauded him and they booed Ron DeSantis. How long can this playbook work, where people don't need Donald Trump to flip burgers and to hold babies and to go around and shake people's hands? He can just swoop in for about an hour and basically give a stump speech, fly off, and everybody says, we like that he's unconventional.
It's a TV show, and he's an expert at it. I mean, it makes for excellent television. The booing gets more stories than the actual candidates, whether that's Mike Pence, Chris Christie, or Ron DeSantis. I mean, the playbook works. I would say keep doing it.
Does rapping M&M work, Henrietta? Does that help?
No, it does not. And I would like to see the polls that are maybe not directed from the internet. I would love to see that for him. I don't give a lot of credence to that candidacy.
Henrietta, thank you. Doing pretty well in some of the polls. Vivek Ramaswamy, who did a fantastic rendition of M&M over the weekend at the Iowa State Fair. If you've missed that, please search for that on YouTube or Google it, Bramo.
Honestly, at what point is this going to be the new playbook? And this has been, right? The more you can sort of be a reality TV star, the more you stay in the public eye, and that's better. More press is better. Do we stay with that kind of narrative? And if that's the case, who can possibly go up against the expert in reality television?
I asked this question last week, and I didn't mean to make light of it. It wasn't a joke. Is the voting about the economy stupid, or is it just simply going to be one big culture war debate? I don't have an answer. I'm just saying my evidence is day to day, culture war is at least what sells cable TV time.
So I'd say one thing about that. Yeah. In the polls, number one issue, the economy. The woke stuff, the cultural stuff, Tom, how's that worked out for the governor of Florida, who's ran really, really hard into that issue and hasn't gained traction? Well, and what we've seen more recently from him is him start to lean in to the economics. So I think that speaks to where issues are at right now.
Where is this in Britain? I mean, Sunak and Labour and Starmer, do they have a culture war debate? No, do they have a culture war debate?
It's happening everywhere.
I don't know.
It's a Western phenomenon. Lisa said is more press great for whoever candidate that might be. I would say right now, not all press is great. Some scathing articles going into the weekend on the Goldman Sachs CEO, David Solomon. I can tell you that at 8:15 Eastern time, so about 45 minutes from now, 50 minutes from now, we're going to catch up with Mike Mayo of Wells Fargo. Tom, that conversation just around the corner on a guy that's really holding on at Goldman Sachs right now in the face of some very critical articles into the weekend.
I'm always going to back Mike Mayo. This is a guy who has been summarily fired for security analysis independence. Mike Mayo is someone who speaks his mind, fact-based. He's not just another conversation. This is the right guy at the right time in the future of that firm.
That conversation in the next hour. Your equity market right now on the S&P 500 positive by 0.2% as we kick off a brand new trading week with equities pushing higher stateside. Good morning.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
Looking to bounce back this morning. Good morning to you. In the equity market on the S&P 500, equity futures positive by 0.2%. On the Nasdaq, up by 0.3%. On the month so far, in the last couple of weeks in August, the Nasdaq 100 down close to 5%. If we closed right here, on track for the worst month of the year so far on the Nasdaq. Just a bit of weakness creeping in to big tech and that heavy weighting on that benchmark. Into the bond market, yields high by 30 basis points over the last 3 weeks. We haven't had a weekly decline in yields for more than a month on a 10-year. 414 at 64. The post SVB failure high is about 420. So we're about 5 basis points away from that on the 10-year. If you want the pre-SVB multi-year highs, let's call it the cycle high, we were through 430, 433 intraday, 434, something like that back in October. So off those levels, but getting there off the back of a big move in the commodity market. Elsewhere in foreign exchange, going into next month, I believe the 14th of September, the ECB decision just around the corner. And then it's the then what? Then what? With the ECB, Lisa, do they hike? And then for the Federal Reserve, do they hike? And then?
And what is the consequence if everyone is basically gamed out in ECB hiking rates more than the Federal Reserve at a time where the ECB is struggling with greater degrees of weakness while still persistent core inflation, especially in light of higher gas prices, natural gas prices? I mean, that's really going to become an issue for the ECB as well.
Natural gas, crude, picking up in a big way. That currency pair, the euro against the dollar, 109.40. Under surveillance this morning, China's Country Garden showing more signs of stress for the property market there. The developer is asking to stretch out a bond payment due on September 2nd over the next 3 years. Country Garden is yet to comment on Bloomberg's reporting, but an indication, Lisa, across a range of businesses now about mispayments, reworking the debt, and it focuses around one part of that economy, the property market.
Which has a lot of tentacles, and we found this with also that private wealth manager who is not able to make payments on all of their products. That was the other news that came to light, as you mentioned. How much do we see this continuing to percolate out? And a task force, is that sufficient? What does that mean? Is that it? That the officials can just basically say, well, think about it, and we're going to look at it. Can they come with some sort of stimulus package, or are they done at a time where they can't or they don't want to reinflate the bubble?
The Yang family have been doing this for 30 years, and Mr. Yang Sr. is retired away. But a single sentence here, and this is from the vast compendium of Wikipedia. After his resignation, Yang Guoqing kept the role of special advisor to the Cayman Island registered company. This is not just a Chinese story like Alibaba and the rest. This is a westernization of their finance under their rules using institutions in the Cayman Islands, among other things. And that's why our radar, that's why our scrutiny needs to be in place, John.
To Lisa's point, we don't know how far these tentacles stretch out, Tom, and what they touch.
Or
but
what
it all
they
goes
touch.
back to one thing. It's the property market right now. And we seem to be talking about it every single day at the moment. Another story for you. Goldman Sachs now expecting the Fed to cut rates in Q2 of next year. Jan Hatzius and the team writing, quote, the cuts in our forecast are driven by the desire to normalize the funds rate from a restricted level. Once inflation is closer to target, we are penciling in 25 basis points of cuts per quarter, but we're uncertain about the pace. What is it about Q2 of 24? Because Mike Gapen over at Bank of America, he's pushed out his rate hike call from September to November, and he also sees these cuts starting, guess when, Tom? In Q2 2024.
But Dr. Hatzi is careful with his language here, and penciling is the key phrase there. That's not a lot of conviction. I mean, penciling in, out. And there's a lot of this, that. Guess what? I would suggest every market economist and strategist is as data dependent as any given governor or president or exiting Bullard for that matter.
John Williams of the New York Fed penciled something into the New York Times a week ago, a week today. And his point was very intuitive, and we've talked about it lots. The concept is as follows. Basically, inflation's going to come down, nominal rates stay steady. That means real rates increase. Lisa, to make sure that real rates are consistent and don't become more restrictive, they have to reduce interest rates. And perhaps that sequence of things starts taking place next year. But given how things have gone this year, can you make a call like 9 months out from now? I can't. I've got no idea.
This is the reason why I actually care less about when they start cutting rates. And I was actually more interested in what Jan Hatzius said about where the Fed funds rate would stabilize. And he said 3 to 3.25%. That's where he sees a stabilization for the new Fed rate. That's what I want to hear from from Jackson Hole? Are they starting to game out what the new neutral is at a time when there is more momentum and there's more strength in this economy than people had expected?
A new floor. Mike Gapin talking about the same thing at BFA. We're on the same page, Brown.
3 is untenable. I don't politically. I don't think they can
take it below
in any
3.
way do a run rate of 3. They gotta jawbone it under 3. I can't frame out an American central bank of 3 or above.
Those conversations about
there.
a week away. Final story for you. The billionaire battle between Elon Musk and Mark Zuckerberg may not be happening after all. The Meta CEO, Zuckerberg, took to Threads over the weekend to say this. He's really taken a high ground on this issue. If Elon ever gets serious about a real date and official event, he knows how to reach me. Otherwise, time to move on. I'm going to focus on competing with people who take the sport seriously. Last week, Musk posted on X, formerly known as Twitter, that a fight was happening, but he might require surgery for an issue with his right shoulder. Then he talked about it taking place in, was it Rome, Italy?
Yeah,
Speaking
gladiator.
to the Prime Minister.
He was going to go full gladiator. Honestly, I mean, at one point, yes, he's being the adult in the room, Mark Zuckerberg. On the other hand, the fact that we're talking about this seriously is so absurd. And that, I mean, honestly, we can't tell. Is it fact? Is it fiction? You get the sense that Elon Musk has been trolling Mark Zuckerberg, and Mark Zuckerberg is sick of it. He's just I don't want to be trolled anymore.
I wish the two would just trot out. And frankly, I'm on Mr. Zuckerberg's. I like his tone on this at least. But two fancy people like that, you go, okay, we're going to go to the Coliseum or whatever in Rome. We're going to do this Billie Jean King extravaganza, and we're also going to fund the high school educations of 10,000 Rome kids or something. Make it applied charity. That would change the dialogue.
I'm with you. That would be very cool.
That would be very cool. Right now, we're going to get a clinic. This is really important. It is Federated Hermes, and the answer with Federated is all of the heritage of the firm that has owned the money market acclaim. Reserve Fund was the first one out there. They get the history book, but it's really Federated, who in 1969 said you could own a portfolio of government securities. In 1976 said you could own a money market fund and make more yield. And that gets us out to where we are next year. Deborah Cunningham is Global Liquidity Markets CIO and historian at Federated Hermes Pittsburgh. Deborah, honored to have you on today as well. Is it a new era for money market funds?
Well, I do think to some degree we're out of the zero rate environment that we have been in for, call it 12 of the last 14 years. So in that sense, Tom, yes, it's a new era. I don't think we get to the point where we are in double digits, anything like that, nor do I feel like we go back to anything that's a zero or single, zero rate or 1% type of environment. I agree to some sense with the 3%, 3.25%, 3.5% terminal Fed funds target range. That gives you a 2+% inflationary rate. Plus you have, call it 100 basis points for risk out the curve to a year. And I think you get to something that then gives you a normalized rate.
Right.
For savers and for those who are taking out loans and paying rates on their cash.
Federated owns a high ground on this. Not so much what money market funds will do. Do you just assume over the coming quarters that the rest of the banking finance establishment catches up to where they should fit in X number of basis points below some high-yielding money market fund that only John Farrell's brave enough to go into?
Well, those really aren't money market funds if they're all that high yielding and you need bravery to go into it. There are some new products out there from banks that are what I'll call brokered CDs, for lack of a better term, that necessarily are not providing the same type of safety, diversification, and quality that you get in a money market fund. These are highly regulated types of vehicles, saving vehicles and cash vehicles. And as such, the bank's true CDs are not catching up to those interest rates that are in the market today. They have to maintain their net interest margin from a banking financial institution standpoint, but they are coming up with other products.
Lisa, I can't convey enough the snarkiness of Deborah Cunningham being a total class act tearing to shreds brokered CDs, which are basically a marketing campaign to bring in a lot of money by finding a number of beeps above ground.
You don't need to have a marketing campaign, though, if you have 3.5% terminal Fed funds rate. And Deborah, this is to your point. How much does cash become a greater staple in people's portfolio if it is income producing, whether it is corporations or whether it's asset allocators at a time where there is a lot of uncertainty? In other words, how much is this not cash in the sidelines? It's just cash, and it's going to stay cash.
You know, Lisa, I think that is where we were prior to 2007. And then the great financial crisis changed. The interest rate environment changed for a very long period of time. But I think we get back to where we were. And it does become a larger allocation. It does become a larger asset class to the tune of not 5 to 7%, but maybe 15 to 20%. And as such, you know, there's a lot of room for industry growth with securities in the market, as well as the demand for the product at this point and what I think going forward.
Deborah, thank you. Deborah Cunningham there, of Federated Hermes. Tom, how many times have you said it so far this year? Gravity's back?
Good. No, I stole it from Nassim Taleb. Let's be clear here that within the equation of derivatives, of which Dr. Taleb is expert on, and someone like Bruno Dupire at Bloomberg is well, the gravity is there, and it's called a real rate. You can bring it over to equities in a sharp ratio where you've got a risk-free rate, but the answer is the gravity's back.
And yields are up, and you can get some yield. And cash is back. It's no longer trashing all that good stuff. For how long? If you believe the rate cutting cycle begins next year, is it time to start locking it in, Lisa?
Well, I mean, and then do you start to see that rally in the back end start to reassert itself because of that? But what she just said there, what Deborah Cunningham said, 15 to 20% of your portfolio could be in cash. This is at a time where you're already seeing money market assets in the U.S. climb to record highs of $5.5 trillion. If you've got gravity, where is it coming out of? How permanent is some of these asset classes that are completely deflated because suddenly everything's parked in cash?
We are hardwired on an income statement analysis. In the old world, Britain and Europe looks at a balance sheet dynamic. So if you have money market funds go from 5.1, 5.2%, with the 3% run rate that Hatzis is talking about, you get out to 6, 7% money market fund. Nobody's framing that right now. And that means, John, on a balance sheet basis, yield up, price down.
Is that how it works?
That's how it works. Price and the answer is, does that fold into?
I'm not following.
Does that fold into disinflation?
Bramo wants you another round.
No, I think it's really. No one's framing this out.
What about the future?
It won't be the same as the past.
Okay, thank you.
No, I think no one's framing this out, and it folds into the inflation debate as well.
Yeah. If you're just tuning in, welcome. Took us a while to get going this morning. Welcome to the programme on the S&P 500, positive here by 0.15%. Coming up very shortly, Pooja Siriam of Barclays at about 8:30 Eastern Time. We'll have that conversation in about 45 minutes from now. I would say don't miss this in about 30 minutes to catch up with us on Goldman Sachs. Mike Mayo of Wells. And you'd have to say someone's having a difficult time over at Goldman Sachs, Tom, in a big seat, the CEO. David Solomon.
Let's move beyond the conventional security analysis, management discussion, and that. A lot of it's been whispered. A lot of it's been alluded to. John, I think in the interviews you and I have done with Mr. Solomon, you know, we've had to talk about his new style, which is very much in all the different articles of the last 3 or 4 days. Someone like Mayo's looking at performance, and I guess what's keeping Mr. Solomon at peace is there's been pretty good stock performance. There's been pretty good performance away from the consumer bank disasters. So it'll be interesting to see how Mike folds pro-securities analysis into the emotion that Lisa was talking about.
I mentioned this with Jared Cassidy last week. I don't know David personally. We've had those interactions and interviews that we've broadcast here on Bloomberg. He's also a decent guy, always a decent guy to deal with when we had those interactions, Tom. But I think we said last week with Jared, there's something about this that feels very, very personal within the bank, within the institution, Lisa. And that's backed up by the commentary we saw in another article, this time in New York Magazine, going into the weekend.
People just saying they don't like dealing with him, that when he walks into people's offices, they get scared. And this is sort of a real concern. At what point does that become an issue if the earnings performance isn't there?
Mike Mayo of Wells Fargo, 30 minutes away. Keith Lerner of Truist, just around the corner. From New York, this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis. We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
The China stimulus narrative is one that the markets have really loved and embraced, and we're getting a bit of a reality check on that. As it relates to commodity prices, all of this news of stimulus has certainly pushed them up, pushed inflation expectations higher, and that's become a big problem for the Fed here, who certainly has not yet claimed victory on inflation.
That was the brilliant Emily Rowland there, the co-chief investment strategist over at John Hancock. Goldman Sachs, they're looking for a rate cut maybe as early as next year. Let's see about that. Will we get stimulus from the likes of China? JP Morgan, Mislav Matejka has pushed back all year against this. He says this morning: we stay unexcited by China exposure despite periodic bounces on the back of stimulus hopes. News continue fading these. TK, that's been the pushback from JP Morgan and the investment bank. They've had a difficult year calling the US equity market. I'd say they've been pretty decent when it comes to calling China and what's developed, or rather what hasn't developed on the stimulus front over the last couple of months.
Well, the stimulus front's there, and like you say, it's what has not occurred here. And the answer is, do you have Beijing-like stimulus? And the real question is, within the formulas, does it distribute out to the cities? And I wonder what's different now is Xi and the dictatorship, the party congresses, the method of politics here. Within the new Xi politics, can you distribute stimulus? That's unproven.
Things aren't great there right now. Tesla making a call to cut prices. Let's have a look at the stock this morning in the pre-market for Tesla. Cutting prices once again in China on the Model X by roughly $1,900 on two versions of it. The stock is down by 2.5%. Lisa, sales in China, I saw deliveries for the month of July slump something like 30+% in July, and here are the price cuts all over again.
So it raises a question of whether this is a China issue, whether this is just a Tesla competitive issue, or they're trying to gain traction against Geely and some of the other local EV manufacturers, or is this a broader story? And we see this not just with Tesla, but other industrial companies in the U.S. that are downgrading their sales picture for China because they don't see the demand there.
Tom, Tesla down by more than 2%.
There it is, and what's the future of it? I mean, John, to me, it's just more about China than anything. The way I'd take this, and this is our conversations with Generous Motors and Ford as well. Craig Trudell joins us from Detroit to talk here about the knock-on. Craig, just as a beginning question, is there a knock-on effect from Tesla China to what, say, the Ford F-150 EV Super Crew? Lisa's looking at this truck at $98,000. I mean, can you take a price cut in China and bring it to a price cut of a $98,000 pickup in America?
I think what we're seeing absolutely and have been seeing, really since late last year is this case of an industry that has been extremely production constrained, swinging to, actually having the ability to make as many cars as it wants to again, and maybe even making more than it has demand for. And so that's why we're seeing price pressure across the board and across markets. So you're seeing Ford bringing down the F-150 Lightning pricing in the U.S., Tesla bringing down prices globally. I think what we're also seeing specifically with the Model Y, the subject of today's price cut in China, is that it's a sort of a complicated story of a rare EV that is selling in extremely high volumes and doing so at strong pricing for quite some time. They were only going to be able to sustain that for so long. If you want to sell in the sorts of volumes that Tesla was sort of getting investors used to, that price point, there's only so much demand there.
You're in the United Kingdom, the land of Alfred Marshall. Is there price elasticity? Is there responsiveness? If they cut price, Tesla or Ford, do we respond?
Yeah, I think one of the key sort of things that everybody's waiting on here is Tesla, updating their lineup a bit. They really have two horses to this lineup, the Model Y and the Model 3, and a lot of expectations of some refreshes of those products in the coming months. If they're able to sort of spruce up the lineup a bit, will that help them sustain pricing and sort of put an end to this week after week, month after month gradual come down in pricing across some of their major markets? We saw a little bit of a pause in that the last couple months, but sort of beneath the surface, they were still doing some tweaks, whether it was messing with inventory models or what have you. They are sort of steadily bringing pricing down as a result of the fact that they brought on so much capacity so fast. We're seeing a lot of the industry do that, right? Try to increase volume, and as they do that, they're going to have to adjust prices down.
So, Craig, we're identifying three different issues here. One is Tesla, two is the broader EV market, three is China. Craig, can you tell me specifically what is happening in China on the demand side?
It's both a story of actually strong demand and yet real competitive pressures, right? So you have an extremely crowded market. You have issues with the fact that BYD and a lot of other Chinese manufacturers have really become competitive in a dramatic way and really sort of squeezed out some of the international players, and we've seen that. Whether it's Tesla, whether it's Ford, whether it's General Motors, Volkswagen, a lot of international companies are really struggling in China in a way that they haven't in the past. I think one other thing to keep in mind here, we mentioned the decline in shipments for Tesla in China last month. Some of that had to do with the fact that they were doing some factory upgrades globally, and that may have to do with changing over the plants to make these updated models. So that might actually end up being a little bit of a blip. They also tend to bring production down at the beginning of the month, at least for local deliveries, and sort of back end their quarters. So we may see some incremental improvement this month and next month for Tesla in China.
Craig, I'd love you to build on what you were just saying. Is China right now pushing out U.S. auto manufacturers even more than they were, say, a year ago, saying that they have electric vehicle manufacturers and really placing emphasis on that? In other words, there's plenty of demand, just not for anything made in the U.S. or by U.S. companies.
Yeah, I think it's really interesting because in the past it was always kind of talked about as something that was maybe a little bit conspiratorial. There was this model for a long time in China of you had to set up local joint ventures with local players and sort of help this domestic industry learn and evolve. And that was really beneficial both to the local companies and to the international car makers that made China the biggest market in the world. For companies like Mercedes, General Motors, Volkswagen. We're now seeing a real challenge of sort of being able to sustain that presence in China, particularly as we've switched from combustion engines to EVs. We've seen the Chinese be able to sort of drive price down in a dramatic way of batteries and innovate in really impressive ways. And you see companies like BYD bring out fresh models month after month whereas Tesla, really has emphasized, just a couple of horses, as I mentioned, the Model 3 and Model Y. They're, doing, more than 90% of their volume of just those two models, and they haven't updated them in years.
Craig, we've got about 60 seconds left. We can squeeze in some controversy. When do you think we'll all stop pretending that all of this stuff is good for the environment?
Oh, man, that's going to be a tough one to sum up in 60 seconds. I do think it's absolutely something that, the industry is talking about, specifically as it comes to, policymakers and the IRA and the countries trying to match IRA. They are going to play that card of, wait, how clean are these EVs being made in China?
John, do you see how the kid from Michigan State, he goes over to London to do Global Cars First. He's that large. And he's popping from East Lansing, Michigan State over to Mayfair. I mean, Craig Trudell, he just looks Mayfair, doesn't he?
That's a better way to cover Detroit, isn't it? From Mayfair.
I think so.
Looking out to Detroit.
I think he's all over it.
More controversy there. Craig,
right before you get into trouble.
Craig Trudell there of Bloomberg. Don't we just, I know we keep coming back to this, and some people have done some phenomenal work on how the marketing around automobiles have been highly manipulative to put themselves at one with the environment. And we do it so much more now. We use EV and green in the same sentence all the time. What's green about? How many tons do these cars weigh, Tom? What's green about this?
Especially because they are, trucks, and they're coming in, and the mining for the materials that go into it requires a lot of an environmental footprint, and it's unclear whether by the time they've already mined it, are they going to be recycling it like they say, or will they be onto a new technology that's
I read carefully an article this weekend, John, you nail it, the weight of the automobiles. Everybody wants a big Ford F-150, and that's not as green as the little itty-bitty thing driving around.
You get a small internal combustion engine and probably better for the environment. Mike Mayo, 20 minutes away from Wells Fargo, from New York City. This is Bloomberg.
Welcome back to a special Western and Southern Open update for Bloomberg TV and radio from Tennis Channel. I'm Erin Coscarelli. Well, all eyes will be on Novak Djokovic in Cincinnati as the 23-time major champion returns to the court for the first time since losing in the final at Wimbledon. The Serb will be looking for his 39th Masters crown and to extend his lead in the all-time list this week. And don't forget, you can watch all the action live at 11 a.m. Eastern on Tennis Channel.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yang1 yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
So what's the best investment advice you've ever been given by anybody? The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping. Look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're getting a couple months of softer inflation readings here. That's certainly going to look like a soft landing. I don't think that's where we're headed.
We've got to price in either lower inflation or lower growth.
Our expectation is that the economy will begin to slow, and therefore you'll see demand kind of slipping off again.
We would be mindful of taking too much risk in this environment.
We will see a more dovish tone coming from the policymakers.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Deep into August, we are on radio, on television. A lot going on in the market. So, shall we mention this in the 6 o'clock hour? Guess what? August, complex.
Retail this week. That's the headline for you. This year so far, this economy is surprised to the upside in a major way. This consumer has been so much more resilient than people thought it would be. Retail sales tomorrow morning, first test for this month. Then on to retail earnings later on this week, with Walmart on Thursday, Target on Wednesday. Tom, all of that into Jackson Hole. How much can this consumer stand the pain of higher interest rates? When do we start to see that bite in a more material way as we go deeper, not just through this summer, but deeper through 2023?
Not only the retail story, and again, to me, I think Walmart's the most fascinating to me. We had Joe Feldman on from Telsey Advisory Group on the nuances of big box, but I'm just as interested in the nuances globally of the consumer, and I can't judge where the Chinese consumer is right now, John. I think it's truly a mystery.
I think we can. Confidence, hammered, and not recovering. And the property market's not recovering either. It's just
property
problem
market's
after
where
problem.
we look. Yeah.
Problem after problem, just bubbling to the surface, Tom. At the moment, we're not seeing that bleed out beyond China into international markets in quite the same way we would have done maybe 8 years ago. We said repeatedly that on mornings like this one, where you'd see concern around property developers, wealth managers, you'd see a bond market rallying, commodities selling off, concerns about Chinese growth. You're seeing quite the opposite. You're seeing yields higher over the last 3 weeks, crude rallying over the last couple of months. And they're the two issues right now that I think a lot of people are focused on this week.
Right now, John, August, back to school reading, and Lisa and I know growing up in America, you read Steinbeck, written in 1961 at gunpoint. You had to read The Winter of Our Discontent, like sometimes even twice through your school years. Lisa, it's the summer of our discontents. There's a whole plurality of issues here across equities, bonds, currencies, commodities. I don't know how someone like Jan Hatzius can look out to Q2 2024. There's too many discontents.
It's the reason why I find it fascinating. This week, we're focused on both retail sales and the U.S. consumer and the divergence from the macro story more globally with China. There's a real tension there, right? Which is the resilience of people in the U.S. continuing to spend, the divergence of the U.S. economy from China, and weakness percolating elsewhere that hasn't really played into substantially weaker oil prices. Yeah, a little lower today, but not a significant sell-off after a 7-straight-week rally in this commodity.
That's the Bloomberg surveillance conversation. I would suggest in America, in the United Kingdom, you've got an entire group of society that is feeling they're in a recession. John Murdoch at the FT last week with that United Kingdom thing of here's the prosperity of London and here's everybody else. You can bring that right over to substantial parts of America.
Barron's, the Journal, the FT, Bloomberg. I think everyone's done phenomenal work on this. Economists are focused on price level change. So they're looking at very high prices starting to stabilize and starting to identify what they would call disinflation. Consumers aren't seeing that. They don't feel that. They just see high prices and high prices. And maybe they're not getting higher, but prices are still high. That's the difference between a consumer's attitude to prices and economists. Economists look to the price level change. Consumers are just looking at this like, this is really expensive, and wasn't this expensive a couple of years ago?
Goofy day here. Equities mid-range, 15.61 on the VIX. John, I'm going to go to the foreign exchange market. I have a yen, dollar yen, weaker yen, printing a 145. It's not 147. It's not 150, but it gathers my attention.
Equities right now just about positive by 0.1% on the S&P 500. Yield shaping up as follows. Just bleeding a little bit higher again now at the front end by a basis point. 490 on a 2-year. On a 10-year, up a basis point, Tom, 416. Getting closer and closer to that post-SVB failure high of about 420 on a 10-year yield.
Get out your log paper and your ruler now. This is a joy. He's Chief Market Strategist, Truist Advisory Services, and the Keith Lerner charm is not only fundamental analysis, but also folding in technical analysis. He was something at Schwab years ago in their technical side. Keith Lerner, technically, are we in the second leg of a bull market?
Well, first, great to be with you for the stellar group this morning. To answer your question, I mean, I do think you have to give the weight of the evidence that the trend is still intact for the bull market. But our view, and really our call coming into August, was that we were going to consolidate, right? Jonathan mentioned earlier, why this market has done so well. The economy surprised to the upside, earnings surprised to the upside, inflation surprised to the upside. But what you've seen more recently is that during the earnings season, instead of going up on positive earnings, stocks actually went down. We had a good inflation print last week, and the markets really didn't do much on that. So I think we're in this consolidation zone. Expectations have been reset high, and I think we just need to move sideways for a bit.
Keith, you and I learned point and figure charts from the great Louise Yamada. She would talk about distribution. Isn't boredom, isn't range bound, isn't distribution healthy to have a continued up market?
I think part of that is healthy. I mean, what we saw even coming after July is that we've seen sentiment reset higher and expectations reset higher. So what have we seen? In the last few weeks here, we've seen the market kind of pull back modestly, and we're seeing sentiment get more cautious already. So I think that's ultimately a positive sign. And I don't think the individual investor ever got to euphoria. If you look at the fund flows from the ICI data, for this year, we've seen equity flows relatively flat. We've actually seen $100 billion go into the fixed income side. So, and the last thing, Tom, to your point, it's normally 2 steps forward, 1 step back. I think at minimum, we have at least a baby step back and some more choppy action here near term.
There is a question, though, going forward, if we do see a Fed funds rate, terminal Fed funds rate of about 3 to 3.5%, as a number of different strategists have been gaming out, what that does to cash allocations, what that does to being more conservative on a more permanent basis. Is that something that you're hearing from your clients and recommending? Deborah Cunningham's 15 to 20% in cash or cash-like instruments that we were just talking about earlier today?
Well, I do think cash has a place in a portfolio. Obviously, at 5%, I think that's much more attractive than we've seen. Now, I will say, if you go back to the mid-90s, the stock market still did well, even when cash rates were relatively high. So I think the good news for investors, which is a lot different in the last decade, is you don't have to take all the risk by just being in the equity market. You can look at the bond market, you can look at money markets, and you have a better balanced portfolio with offsets. Before this, it was a really hard time. We had a lot of investors that we were dealing with that were taking on too much equity risk because there was no alternative. So I think, fundamentally, this is a positive for investors.
When people take a look at equities, I've heard a number of people saying they're looking more at commodities, at banks, at some of the areas that haven't really gotten as much love this year. Are you in that camp that now is a time to buy energy stocks, especially in light of the rally, despite some of the concerns over in China?
Yeah, we actually more recently upgraded energy. We do think there's more upside there. If you think about energy the last few years, it had a big year last year. This year, it's only up about 2%. We've seen those production cuts on oil, and we've seen oil prices rebound quite a bit. They're still very cheap, generating a lot of cash flow. So we do think there's more rotation there. The challenge for the overall headline market, it's only about 4.5% of the index level. So what we're seeing here short term, which likely is to continue, is money coming out of tech and moving to other areas like energy, financials. And one area we continue to like is the average stock or the equal weighted S&P index, which is a little bit less top heavy.
Keith, what happens to the equity world if bond prices break down? If we do get, even if it's ever so slightly, we break support on price on bonds, we get lower price, higher yields. What does that do to the stock market?
Well, I think we're already seeing that as we moved above 4% for the market, it put a cap on it. If you think about the S&P forward multiple, we're above, we were at 19.6. We've pulled back to just below 19. But if you continue to move up on the above 425, I think it really puts a cap on how much higher expansion you can get, and probably actually start to see some compression. If you look at another way of looking at this is the equity risk premium, right? The equity yield relative to the bond yield. That's at the lowest level in about a decade. So I think that just constrains the upside the more that we see yields move higher here. And I think for the market to do well, you need them to at least stop moving up.
We were talking about China earlier, and I'm curious from your vantage point, how closely you're watching that story as we do hear about missed bond payments, the possible extension over at a major property developer or a financial services firm not being able to make payments. Do you care? How long can the U.S. economy remain divorced from what's going on over there?
Well, we do care. I mean, from an asset allocation perspective, we've been very negative on China, and that's one of the reasons why we've been basically zero allocation in our global portfolios to EM since last year. And I think the main thing is it's just, you know, we talk about the stimulus, and you had this big rally of hope, and you've given all that back. And one of the things outside of all this that we pay attention to is the earning trends. How are those earning trends in China looking relative to the U.S.? And they're making new lows every week, and they've been doing this for over the past year. So from our perspective, it's a negative as far as for emerging markets because it's about a third of that index. And then more specifically to your question, I mean, it does, you know, a big part of the deflationary story was China. So it will have some impact on the U.S. and keeping inflation probably higher for longer.
The data has been really difficult over there, that's for sure. Keith, got to catch up as always. Keith Lerner there of Truist Advisory Services. Talked a lot about some of the scathing pieces we've seen in the press on Goldman Sachs and its leadership under David Solomon. More scathing pieces going into the weekend. Within one of those pieces from New York Magazine, the likes of Mike Mayo cited over at Wells Fargo. Let me share the quote with you. I've called for CEOs to be fired before. If it's warranted, I'll speak up, but I'm not seeing it from the outside metrics. Mike Mayo, Tom, on a difficult week for David Solomon again over at Goldman Sachs. He's going to join us shortly in about 5 minutes.
I'm going to link Mike Mayo and the financial analysis that he's claimed for in there. He sees a constructive view on Goldman with William Cohan in his book Money and Power. I get thrown at every kid that says I want to work at Goldman or whatever. And the answer is there is a cultural fabric to William Cohan's book that's completely removed from what we saw in a set of articles this weekend.
Well, this goes to what Gerard Cassidy was saying, right? I mean, is Goldman Sachs' performance that bad, or is it just that people don't like David Solomon? I mean, these are the two distinctions here. And are we looking at a piece where people are saying they just don't like him? It has not as much to do with the performance of the actual company.
On reading that piece, it feels deeply personal, and we can talk to Mike Mayo about it in about 5 minutes' time. Looking forward to that. If you are just tuning in, welcome to the program. Equity futures right now on the S&P 500, just about positive, but rolling over. We're positive here by 0.1%. Talked a lot about the week ahead. Retail sales tomorrow morning. We're going to hear from Walmart on Thursday, Target on Wednesday. I believe we have some Fed minutes in the mix as well, Bramo?
Wednesday,
yeah. That's going to be the mix too, off the back of the Fed speak of the last couple of weeks, Tom. Feels like for many we're at some kind of inflection point with Fed policy. Who gets the stage in the minutes, the Hawks or the Doves?
If UATA shows up at Jackson Hole, is Jerome Powell's central banker of the world. Stephen Gallo moments ago publishing Bank of Montreal, BMO Capital Markets, and it is a detailed note on the persistency of interventions, what it means for the Bank of Japan, what does it mean for Ministry of Finance, frankly, what's it mean for the Fed?
You think they start intervening in the FX market? What's Stephen saying?
We're at 145, and we've broken through this morning to 145.20, and he's just saying it's not only the parlor game of will they intervene and what's it mean? Can I trade? Can I hold overnight? But every time you intervene, you lose a little bit of firepower. You lose. That's a classic Dornbush analysis. You lose a little bit of oomph every time.
If they want a stronger currency, they can do something about it with rates, can't they?
They can do it on the other side with rates. Absolutely. Intervention's not just the only.
They could do the unthinkable, Lisa, and hike rates next year.
What I find interesting, how much of the move in the bond space is just directly tied to the Bank of Japan. And this is something people are talking about, that even just the suggestion, the whiff of moving away from yield curve control has unanchored or perhaps just loosened a little bit of the anchor for global bond yields.
There were two anchors around the neck of the global bond market. The bond market, driven by the ECB, anchors away. The BOJ, slowly coming back up. I'm with you. I'm with you. And again, if you ask 5 different people what's behind this move, 5 different reasons. Yield curve confusion is one, commodity market is another, treasury supply, data, the resilience of the US economy, take your pick.
And then people will say, I just reject it. It's just technical. It's just wrong.
It's just technical. When you disagree with all of the above, it's technical.
This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Post.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
I don't think it can be sustained. You look at 2% real yields. You've got to go back 15 years to see them being reasonably sustainable to before the global financial crisis. You look at this 4% US GDP nowcast we've got. You've got to go back, 20 years outside of the pandemic. So I think this is pretty much the top, and I'd absolutely be leaning against it.
That was Ben Laidler, global market strategist at eToro, who's been constructive over the years on this equity market. So that's the context for those particular comments this morning. Let's look at the equity market together. In the S&P 500 at the moment, futures are just about positive by 0.1%. Yields have been climbing now for the last several weeks. We've talked about the move over the last month of about 30 basis points higher. This morning, up by a basis point, 416.59. Just some interesting levels to watch for you. Since the failure of SVB, we came very close to breaching 420 and staying there. Then we backed away. So that's the post-SVB high. The pre-SVB failure high in the bond market, in this cycle at least, was back in October, north of 430. It's just interesting, Tom. We're going back there. Just yields, just climbing, commodities, rallying. This is two pieces of a focal point, I would say, for this market at the moment.
And on a Monday, it's moving in real time, John. I just noticed moments ago a nice pop-up in the real yield, the 10-year real yield. We may print a 1.80%, and I think that would be of note, not only to bond participants, but the economics racket as well.
We need to talk about Goldman Sachs, Tom. Some scathing articles going into the weekend, including this one from New York Magazine, shared by pretty much everyone I'm friends with, Tom. I got that in my inbox multiple times from multiple different people. The lead paragraph is pretty bruising. The headline is something I haven't read before about a banking CEO, at least in the last 10 years, Tom. Is David Solomon too big a jerk to run Goldman Sachs?
Yeah, Lisa, John, and I really talked about this Friday about how to handle this, and we're going to handle it the way we've handled it for years. We're going to talk to experts. I spoke to our Sri Natarajan multiple times through the weekend, went back and forth with him this morning, and he will report on this along with our New York finance team. We welcome all of global Wall Street. In 1999, Mike Mayo got his butt fired at a major bank. It was a testament to all of us in the racket about independent securities analysis. The culmination of that was the Forrestal Award. John, it's the #1 award at the CFA. And I can't tell you, in 2013, the symbolism of Mike Mayo fired one evening for being independent, winning the top award at the CFA on ethics. This is a guy to speak to, Mr. Solomon.
The star analyst at Wells Fargo now, Mike Mayo, joins us. Mike, wonderful to catch up with you, sir. Let's talk about this story and the criticism around the Goldman Sachs leader. Do you get the sense this is strategic or deeply personal?
Well, thanks for having me on, and thanks for bringing up the CFA, which is the preeminent accreditation for a financial analyst. And I actually go back to those roots to think, how should I approach the situation about the CEO of Goldman Sachs and the differentiation between the external metrics, which are good, and potential internal metrics, which might not be so good. The issue here is I'm not seeing these metrics. I don't have these internal metrics. The company said they've not had any unusual turnover in the partner ranks relative by the numbers. So I'd say, look, what it comes down to is winning cures all. Goldman's had recent performance issues. They've missed expectations 2 of the last 3 quarters. And when that happens, other issues move more to the fore. And if I were to summarize the 3 issues, it'd be the 3 Cs. One is the consumer expansion. That was a debacle. Second is the cultural change. David Solomon running Goldman more like a public company, almost 25 years after they went public. And the third would be his character and, some attacks in the press on that character. So I'll go wherever you'd like to go.
Well, Mike, I want to go to what has to happen in order for the character issues to not be center stage anymore. In other words, has he lost the room to such a degree that they need to have blowout performance and growth in an area that is yet to be identified?
Well, going back to the CFA, the basis on how I should perform my job, it is the job of a CEO to uphold the reputation of the firm. So that is important. But when we talk about upholding the reputation of the firm, we're talking about being #1 in advisory for the last 20 years. We're talking about Goldman growing capital markets twice the pace of peers over the last 3 or so years. We're talking about reputation of the firm to their multinational companies, to governments, to their most important investors. So where it matters the most, they are upholding the reputation of the firm based on the business that they're doing. But could there be a point where there's enough upheaval that, the media, the tail wags the dog? I suppose it's possible. It's just not going to happen, right now.
Mike, you said the turnover that we've seen in the partner ranks hasn't been that unusual, and yet we're hearing about Lloyd Blankfein being brought back to the firm and really going after David Solomon, having some pretty strong words for him. What do you make of that? I mean, do you think that just basically there are a lot of bitter people talking to members of the media?
You know what I really think is happening here? I think it's, and I don't have the numbers back this up, so I'm just going to give ballpark numbers, but I think it's like, traders who are earning $6 million a year who got paid down last year to $4 million a year or something like that. It just zip code wise. I mean, they had a blowout year in 2021. Last year was a bad year for Goldman. People were paid down when they had great years. They were partly subsidizing this failed foray in consumer banking, and they're upset, and they're taking and they probably go to the CEO, and the CEO, it's like, look, when has the Goldman Sachs CEO been a warm and fuzzy person? David Solomon, I mean, you have to have strong opinions to change a culture like he's doing while trying to generate profitability. I think a lot of people are upset about what they're getting paid, and they're going to the press with it.
Mike, you're expert on board analysis. We have a new board member, Mr. Montag, obviously Goldman Sachs Timber over at Bank of America. He returns. You've got someone like David Viniar who ran the ship in 2007 under crisis. Color the board makeup and decision right now. How do you look at the Goldman Sachs board?
Tom, I've been a critic of bank boards, and it probably represents corporate boards, more generally. I feel like they're soft. They don't really hold managements accountable. They don't listen to shareholder concerns. So when I look at Goldman Sachs board, more than anything else, like any bank board, I think their push for change is probably not that much. That's the reality of corporate America. And, I wrote my book about it, and I still see it. And there's some other banks today I'm happy to talk about where I think there's much more need for change than at Goldman Sachs. So, wait in line. And I do want to address your Lloyd Blankfein comment. Lloyd Blankfein started the push of consumer 7 years ago, and he amplified, and it took up, all the discussion in the room almost in the meetings. And now David Solomon doubled down on consumer, but it was Lloyd originally, and Lloyd probably doesn't like to be, tainted with some of these, $3 billion of losses they're getting out of, the Marcus business aside from the deposits. So, his hands aren't completely clean in this whole situation either.
Mike, we've got about 60 seconds left. If we could finish by asking you a pointed question, that would be good. How would this stock respond if that headline dropped across the Bloomberg that he was out?
I don't think the stock would go up. In fact, the stock might even go down. Remember, I called to have the Citigroup CEO fired back around after the global financial crisis, and I think the stock went up that day, and that was a good moment. And we've seen that other places where the CEO goes. But if David Solomon were to be fired today, I think the stock would actually go down, because then it would be like, wow, you're running the company based on media reports as opposed to financial results. And by the way, when I talk to investors aren't saying, oh, get rid of David Solomon. They're really asking the questions you're asking. Hey, does the media impact their performance? I'd say no so far. Yeah. Having said that, David Solomon has to earn his job every day. And so I can come back in 3 months or 6 months, and he doesn't get the job done, I'll be on the other side.
We appreciate your opinion, Mike, as always. Mike Mayo of Wells Fargo. It's a question we've asked all morning. Is it strategic or deeply personal? And you have conversations like that, and it just feels more and more like it's deeply personal within the bank. Mike Mayo there of Wells Fargo. Your equity market just about unchanged on the S&P 500. From New York, good morning.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
how do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg surveillance on Monday in August, and we have been remiss. John Farrell preparing for the next hour, Lisa Bramwitz and Tom Keene. And, I've barely discussed this, but on the radar this week is a fair amount of economic data, starting with something that really matters. For the first time this morning, we discuss retail sales tomorrow.
Yeah.
What have we been doing? China this, China that.
John's mentioned
Goldman
it.
Sachs,
We've
retail
mentioned
sales.
it. And then we've got Walmart on Thursday, and on Wednesday we've got Target. Retail sales coming out tomorrow at 8:30 a.m. at a time where the U.S. consumer seems to be pitted against all of these macro concerns because the consumer keeps spending, and that has been the story. And so we will get the latest read on that with the expectation of a reacceleration of some retail spending.
Fed minutes, I believe it's the 16th.
Wednesday, yeah.
Wednesday, Fed minutes, do I care?
Yeah, I think just to see if there's a shift in tone in terms of not, being that aggressive or letting some sort of soft landing percolate out.
I'll let you read them. Right now, we're going to dive into the American economy and get you ready for this economic week, particularly in the American consumer. Pusha Shriram joins us, U.S. economist at Barclays, for a good discussion here. Futures were green on the screen. They've rolled over a little bit. Yields nicely higher, 3 basis points in the 10-year yield. And I'm watching FX, where I've got yen still weakening. There is a movable feast in Pacific Rim currency this morning. Lisa, look at sterling, 126.65. I mean, there's some movable parts here on a Monday. One of the movable parts in mystery is the American consumer. Pusha Shriram is U.S. economist. Barclays, what's the state of the American consumer? What will you look for in retail sales data?
Yeah, well, thanks for having me on the show. I think the U.S. consumer still remains extremely resilient. I mean, from the last time I was here, we really haven't seen much in the way of either hard or soft data to suggest that things could be slowing. As for retail sales this week, we think it's going to be a pretty strong print. We're expecting a 0.4% increase on the month. Some of this, could plausibly be an Amazon Prime Day event-led boost, which typically, seems to be the case for the July reading. But, even outside of that, we think there is still a fair amount of momentum in consumer spending. We also, tend to look at where excess savings are headed. That pool of savings still seems to be, a fairly decent pot. So, going by all of this.
Atlanta GDP now, 4.12%. You're saying there's an asterisk there because of Amazon Prime?
Well, not an asterisk there, Tom. I think they would have, that's a nowcast. But, to the extent that that's still a 4% handle, we think it could be a strong third quarter.
So what happens with student loan repayments, which are supposed to start in October? What happens to the savings pool that's supposed to be whittled down? What happens to the fact that oil prices and gasoline prices are going up? None of this stuff really matters at the end of the day. Well, I mean, but this is but this is what people are asking, right? When do we start to see that actually take a bite out of consumer spending?
Yeah, that's a good question. And I think what we really need in order for some of the slowdown to materialize is to see monetary policy that's somewhat a little more restrictive. And I think that's what and I think that's what we've been saying. I think we still think that there's one more hike that's likely. When the FOMC looks at the data, I think they're going to be convinced that economic outlook is positive. If anything, they actually upgraded their assessment of economic conditions in July.
So are you pushing back against people who say that we're sufficiently restrictive or overly restrictive right now, that the Fed funds rate actually is not yet restrictive at a time with this much growth?
Yeah, so, I think that's a fair point. And, we've been looking at it this way. So late in the hiking cycle, Lisa, we're still seeing such a resilient economy. It's been very unusual, right? I mean, at 5.25 to 5.5, the Fed funds rate hasn't been at this level since mid-2007. And, we're still in an economy which is showing no signs of slowing. So that really leads us to question, A, has monetary policy really struggled to gain traction? And B, if so, what's really happening? And, we put out a note to clients on Friday. And, there's been some new estimates from the New York Fed about R-star, which is the natural rate of interest. And, some of these model estimates seem to suggest that this natural rate of interest could have, is possibly higher now.
Like what?
About 50 basis points higher for the long run rate. But interestingly, they also have estimates for the short run R-star, which is, which you can compare to the Fed funds rate. And that's about where policy is right now. So it leads us to question, what if policy really isn't as restrictive as one would generally think? And, really, the FOMC is, I'm sure, aware of these estimates, and that would definitely be on their radar screens, when they make future policy decisions.
You were at London School of Economics, where you have to look at the Phillips curve, the physical thing that Phillips invented in 1951 to come up with Phillips curve dynamic on inflation and jobs. You tripped over the beverage curve, I'm sure, on the way to the lunchroom. The answer is, does that theory work? Are you flying blind now, or you're making it up with data? Or can you and Chairman Powell actually have a theory?
Well, I think these frameworks, Tom, are still pretty useful to the extent that, we still have a Phillips curve. Yes, it's not dead, as a lot of people make it out to be. That gives you a good starting point. But yes, we're looking at the data. We're looking at the beverage curve to see where we are moving. It looks like we've shifted somewhat lower. So that's a move in the right direction. But I think the broader point that we want to make is, maybe there is a little more room for policy to become restrictive. We shouldn't celebrate so early about disinflation. I think that's something that we learned on Friday as well after the hot PPI data. So I think there is, some more room for progress.
Or is the system, this goes to Jackson Hole. I hope there's a paper on this. We don't know yet at Jackson Hole. McKee's the only one on the planet who knows what the papers are. He won't tell me what they are. But do you aggregate into a summed American economy analysis, or do you have to disaggregate to be polite into two Americas, or dare I say 4 or 5 Americas?
Well, I think, based on the data we have available, Tom, as economists, we have to work with the aggregate picture. Even something like the savings rate, we don't really have a clear picture of what's happening at different income decile levels. So we are looking at the aggregate America to get a good sense of where the economy is headed.
We're speaking with Pooja Sriram of Barclays ahead of the retail sales data that we get tomorrow, and also, of course, in light of what we're seeing internationally. And one of the big themes that we've been having today is this question of when does some of the problems that we see percolating out of China start to make a dent in U.S. economic growth? Are they so divorced from one another that it doesn't ultimately matter this time around?
Yeah, that's a good question. So I think a lot of that is sentiment for sure, what's happening in China. We take particular interest in terms of the inflation that spillover from China into U.S. I think that disinflation narrative really supports what we're seeing in the U.S., especially on the goods side, so that should be good news. But really, we've got to wait and watch to see if it's enough to dent the resilience that we've seen in the U.S. Economic activity so far.
Well, there's a question also around oil prices, and they've been picking up in large part because of the supply contraction out of Saudi Arabia, but also this idea that, yes, China was weak, but they would be stimulating on some capacity, so you would see some little boost there. At what point are high oil prices inflationary versus disinflationary, deflationary, given how much it takes out of the paychecks of U.S. consumers?
Sure. I think, to your point, we're already expecting to see the impact of a higher oil price in the August CPI report. And, I think a lot of people have pointed that out. To the extent that this can continue to seep into non-core components, what we need to really look at is the pace of increase in oil prices and whether they will sustain. I think that's something that we will be watching very closely to see how that plays out for the inflation narrative in the U.S.
I want you to fold in, with the markets moving right now, something that's acclaimed of Barclays economics for years is the ability to bring foreign exchange into this. The fact is, on a Monday morning before retail sales tomorrow and that, I have a renewed, stronger dollar. There's yuan, which with all its obviousness is weaker yuan, but I have dollar yen slipping away. There's no other way to put it. I've got yen 145.00, suddenly 145.38. I've got sterling well under a 127 as well. Are you, when you link in to Barclays' strategy, can you link in and make some form of dollar conviction, or is it just a mess right now?
Well, I think some of this is a lot of as a reflection of the resilience and strength in U.S. economy vis-a-vis the rest of the world. So I think some of the move is that. But yeah, I think we'll have to watch out how the data play out. Look at what's happening in the U.S. vis-a-vis what's happening in the rest of the world to really get a sense of where the fundamentals are headed.
Is Jerome Powell, as he goes to Jackson Hole, is he central banker for the world? To me, is far more than what's in the zeitgeist.
Say that again.
Is he a central banker to the world right now? I'm stealing from Bill Rhodes.
Well, really, I think the whole world is going to be watching him quite keenly to see what he has to say. It's a great stage for them to outline how they're thinking about policy at this stage. A lot of people seem to be convinced that they can engineer a soft landing. So, we'll be looking for clues to see how they're really looking at the economy, what they're making out.
Right. Pooja, thank you. Pooja Sriram with us with Barclays this morning. So we got to go back here to markets on the move. Equities peel away a little bit. We had a little bit of a gain. We got some negative. Excuse me. I got VIX up a stick, 15.92, getting to where we are. But you really wonder if there's news out there right now. I've got sterling off a cliff, 127 to 126.60. These are little moves, but in the doldrums of August, they're tangible. I mean, where does yen stop? 145.35? I can't believe I'm framing that right now.
Right, and at what point do they come in and intervene? I'm watching the front end of the yield curve because a lot of the sell-off has been at the back end, but today we're seeing it more at the front end, a little bit more, with this idea, exactly to Pooja's point. At what point does the Fed have to consider getting more restrictive if the rate hikes that they have implemented haven't had the impact? I mean, you were pointing to earlier today, 7.35%.
30-year bank rate.
On the mortgage.
30-year mortgage.
When does that start to affect home prices more?
Well, I would two-part it to the oddities of urban idiocy like New York City. We're all living this here. Versus what I'm seeing out west, which is some tangible rent declines. It's a generalization west of the Mississippi River.
Well, and the rent
maybe west of Denver.
That's been one of the big arguments for disinflation is that the rent, declines will actually feed into that. But then in other areas, you're starting to see it reignite. Again, it just goes to this question: is this just people who have termed out bond yields and so are able to avoid really understanding what this actually means for their bottom lines, or is it just that this is an economy with way more power than people thought?
And again, within the litmus paper of the system, we do have markets on the move. Sterling right now, 126.60. I know John will have a lot of this here in the next 20 minutes or so, but just giving way one through that important level, 126.60 as well. Standard & Poor's 500, bit red, down 0.2%.
Yeah, and Tom, I do think that is the point, which is people are looking around for news on a quiet August, right? I mean, what were we hearing from Elsa Linos that everyone's on vacation, and so there's a lot of range-bound trading until then.
Pooja Sriram isn't.
Neither are we. You haven't taken a lot, actually.
No, I'm due. I'm taking huge amounts of vacation, and I'm actually trying to get to China at the end of the year, and I'm not sure we can pull it off.
Did you see that
they're not that open?
They're opening up some of the routes, though. Did you see that?
I'm a little optimistic, and you mentioned last week fares are down domestically. They're a little bit down internationally, I would say, but it's still the silly season.
But this is ultimately the question around some of the oil prices that are going up. the disinflation that we're seeing, how long can it last if you see oil prices truly going up? And believe me, I would like to see plane tickets.
And the news flow that's out there right now, and we're searching for the news flow here of markets on the move, is Brent crude down a stick, all of a sudden down 1.4%. Brent 85.63. West Texas not making a dash for a 79 level, but 81.90. Down $1.29 in West Texas Intermediate as well. I'm looking on a Monday, August, as Lisa mentions, is I guess the doldrums of the summer. I'm looking at where we are on just simply foreign exchange markets, and you go out to the little bit of a market, and all my radar's on dollar yen. I can't fathom within the summer of Tokyo what they're dealing with now, a second intervention perhaps.
Yeah, and as you said, it has less impact with each time. Again, people trying to understand the China story. If you don't have China that's recovering,
I do agree with that.
This to me is underpinning a lot of the uncertainty.
Please stay with us. More than an eventful Monday, to say the least. Coming up, Drew Mattis of MetLife, a timely conversation on radio, on television. This is Bloomberg Surveillance.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
We are about 45 minutes away from the U.S. Open, and we can see a bit of a fading in some of the action. And you mentioned this, Tom, earlier, that we are seeing stocks roll over after initially shrugging off some of the concerns around China, with S&P futures down about 0.2%. Euro dollar just basically stasis, but the dollar strength you can see pretty much reasserting consistently. It's tangible, which is interesting given everybody calling for a weaker dollar. And then in the yield space, yields up, continuing their upward trajectory. 10-year yields almost to 4.20. That is really a shocking moment, considering that we're taking out what happened over the past, 4 months.
Yeah, I totally agree. Before we get to stock movers, that you have to take this all back to benchmark yields, and the 10-year United States yield is there. There's some German yields that are as important as well. But, the bottom line, there's a banner headline coming out now, a year weakness back to July 6, where we are now. We may get a 108 on euro, which is shocking in itself. But I agree, all you can hold yourself onto here is benchmark analysis. And to me, is a 30-year mortgage a benchmark statistic? I'm not sure, but nevertheless, wow, there it is, 7.35%.
One day that would have been a really incredible statistic, and people seem to be shrugging it off. And the single stock names, honestly, it's been an interesting morning of divergence. U.S. Steel really standing out after rejecting an offer from Cleveland Cliffs. Yeah, exactly. Maybe Elon Musk will get a hold of it. Basically, rejecting an offer from Cleveland Cliffs. This was something that Cliffs said, that United States Steel had called the offer unreasonable. Steel later confirmed the response. It said that it's trying to find strategic ways to manage its assets, but nonetheless, those shares up almost 30% at a time when the U.S., I'm assuming, would want to emphasize some of their industrial production.
Well, there's a historical baggage here, and I'm sure it's not going to go to semiconductor factories in Ohio or whatever the romance of the Biden administration is, but it's such a legacy of the nation. There's such a collective memory of X that it distorts any rational analysis I would do.
Well, but it comes at a time where the U.S. is looking to rival China in certain capacities, and the combination of these two would create the second biggest, I believe, steel company worldwide. I also just quickly want to touch on Tesla, since those shares are lower after they cut prices over in China down about 3.1%. And this, again, is this a China story? Is this a Tesla story? Is this an EV story? Nikola, also interesting. It's falling substantially more than about 18%. That's an electric vehicle maker, Tom. They had some fire battery that had an issue.
This stuff scares the hell out of me.
And so, there was an electric malfunctioning in the batteries, and so they are recalling certain vehicles, and those shares are lower.
Right now, we're going to get a brief as we talk to Pooja Shriram of Barclays. Right now, we step into a discussion of the markets with the economist Drew Mattis, chief market strategist at MetLife. He was on. We had a huge response when Drew was on last time, so we redux it again. Drew, are we amid disinflation and in selected economies outright deflation?
Well, in the United States, if you look at goods prices, we're in deflation now for that. And the question is, how pushy will service inflation be over the next couple of months? And how long is that going to hold up overall inflation in the United States?
Well, how long will it hold up inflation? But the answer is we have to fold this into our market belief. How do you, with all your acclaim going back to Ethan Harris, Maury Harris and all, you only work for people named Harris. I guess that's what we learned there. But, Drew, I look at the economics of Drew Mattis and I say, okay, I can go into a guess on what price is going to do. Then how do you fold that into a market analysis?
Well, for me right now, what I'm focused on in inflation is one of them is imbalances. What kind of imbalances exist and what does that mean for the economy and growth going forward? And so for the medium term, I'm trying to figure out when the recession occurs, how deep it's going to be, what's going to cause it. And quite frankly, kind of the longer the imbalances persist, the worse the recession will be and the more you have to worry about it. And so things like you were talking about earlier with regard to housing, housing should be repricing. The fact that it's not is not a sign of health. It's a sign of dysfunction. And I think that that's something that could come back to bite us in terms of, we begin to generate some momentum in the economy and all of a sudden people need to move for work or when they've retired, they want to sell their house and switch to a different house. There are no trade downs happening anymore, right? If you've hit retirement age and you want to switch to a smaller house, there's no point, right? Because you'll end up with the same mortgage payment and a smaller house. So why would you do that to yourself? And so that kind of dysfunction creates problems for the economy that'll come back and reverberate for the next couple of quarters at least.
How do higher oil prices fall into your thesis of rapid disinflation?
Well, so that creates another distortion, right? Should we, in a time where it seems like growth is coming back into kind of a more sustainable trajectory and everyone's talking about a soft landing, should oil prices be behaving the way they are? Should they be behaving the way they are when we see weakness overseas in markets that typically import a lot of oil? So once again, something that doesn't quite fit a narrative that's being put out of kind of a soft landing and all's right with the world. And so I think it's something important to watch for going forward.
How much are you watching China? I mean, this morning we've been really focused on what happened over in China with respect to their developer, with respect to a private wealth manager not being able to necessarily make payments on some of the products that it had tied to real estate and other types of investments. How much of an effect would some of that weakness have on the U.S. economy, or have these two economies diverged enough for it not to really make a material difference?
That if you had material weakness in the United States, it would translate to China. If you have material weakness in China, I think it'll translate into the United States. There might be a little bit more of a delay in getting here, and there might be, a different routes that it takes. But at the end of the day, I think, you end up in the same place, which is in order for the U.S. economy to be doing well, in order for the global economy to be doing well, all the boats have got to be moving in the same direction. And right now they're not. You have more weakness in parts of the world, and you have, kind of strength in the United States. And once again, something that doesn't seem sustainable in the long run. And so that's something that's, caught my attention, and I think it is worth focusing on as we move forward and try to figure out where we're going to be.
Drew, I don't want to get in trouble with the general counsel of MetLife, but I have to ask you, not so much the nitty-gritty of MetLife, Metropolitan Life, and commercial real estate, and all the huge investment that you have there, and the mathematics of it to the point. But how does Drew Mattis synthesize how CRE fits into your risk profile? Is it overplayed? Should everyone calm down, or is it a tangible fear?
Well, so Tom, I'm going to duck that one. I'm going to, we have a great real estate team, great real estate research team, and I would defer to them on that. I'm sure you can reach out and
oh, come on, you're on with us now. I mean, there's nobody watching in August. Just the CRE, thumb up, thumb down at MetLife.
Look, every asset class you could possibly look at is always going to have good places to be and bad places to be, right? And so, having the kind of research that we have available at MetLife, allows us to kind of better insight into that area.
Boy, did he answer. That was great. I think it's like Powell at a press conference. Drew was reading that off a card. Drew Mattis, thank you so much at MetLife for that non-answer on commercial real estate. Maybe I shouldn't have asked him.
Most controversial thought of the day, maybe. Actually, probably not. The idea that commercial real estate's coming back because people are going back to the offices, and this idea that work from home is kind of losing luster in some places.
I'm reading, I was stopped on the street, walking around the Manhattan streets. This happens to Lisa and John, too. We get stopped all the time, and I was stopped by a major hitter in real estate months ago. And he said, it's just simple. There's a Class A partition with Class B, Class C real estate. And, of course, MetLife only owns the creme de la creme. But then beyond Class A property is which kind of commercial real estate. I'm trying to read as much as I can about the certitude of office buildings are not a good place to be. But what about apartments? What about multifamily? There's other places to go.
You know what I just don't understand? This is a very U.S. phenomenon. Self-storage and the massive amounts of self-storage when you drive across the country. Have you ever had a self-storage unit?
No, I have never, to this day, I've never had one. I'm really big on throwing stuff out. But it is a nation of pack rats, and self-storage is the way to go. I mean, Vet-Bill's got 500 square feet over on the East River.
Yeah, what's he got?
Treats, winter stuff, coats, treats. It's got the little green chewy treats.
Does he have little Crocs?
Thank you to our team today, particularly for that conversation with Michael Mayo. This is Bloomberg. Good morning. And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
The Fed, the market analysis. We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get your trading week started. Live from New York City this morning. Good morning, good morning. Your equity market just a little bit softer. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, Goldman pencils in the first rate cut in 2024. Worries build over China's real estate market, and Tesla begins cutting prices once again. We begin with the big issue, sustaining life above 4%.
This is not the time to panic about duration.
I still think sort of long duration assets are the place to be.
All of these types of sell-offs, that we are seeing in the market.
I think a lot of this bond yield move is technical.
We think of them as opportunities to go long Treasury. We're using duration as a hedge to a growth shock.
Joining us now to discuss is Allspring's George Bory and Nuveen's Tony Rodriguez. Tony, let's start with this bond market. Yields above 4% on a 10-year at about 4.20. Tony, how much oxygen is left up here?
Well, good morning, Jonathan. Good to be with you. We would say, Nuveen, that there's not a lot of oxygen left. We think that the previous peak that was set in that 4.25 area is really going to be very likely to hold here. So from our perspective, when you get the U.S. 10-year above 4%, that begins to be a very attractive area for investors to begin to take on some longer duration exposure. So whereas we were relatively defensive on duration throughout all of last year, as we moved here into 2023 and we've been hitting that 4% level, that's an area we begin to like to get our duration back to neutral. We're not expecting an enormous rally from here, but we do think it's an attractive place to earn some attractive income and gain a pretty good hedge against some potentially negative outcomes, because in a negative economic shock, we do think we'll see rates fall pretty aggressively.
George, do you agree?
Well, we would agree that adding, duration in here certainly makes a lot of sense. And we've been sort of steadily doing that, small incremental adds as yields have gone up. The most important thing, Jonathan, is not so much where nominal yields are, but it's where real yields are. And real yields, as we talked about many times on the program, have moved into in positive territory. And it's time to let the real yield kind of work its magic, so to speak, both from a policy perspective, as it affects the economy, it affects borrowers, it affects economic behavior, but from an investment perspective, when you can lock in anywhere from, say, 100 to as much as 600 basis points in positive real yield, as a bond investor, that's sort of the golden days for bond investing, and that's precisely what we're trying to do today.
Income is back, and you're getting more yield over the last couple of weeks. Can we just start with this Treasury sell-off of the last month or so? George, can you walk me through what you think is behind it, this 30 basis point move in the last 3 weeks on a nominal 10-year yield?
Yeah, I think, clearly the data has been good. And there's the hanging question over the market is really inflation. Growth is clearly slowing. There's plenty of headwinds that we think will mount as we move through time because of tighter policy, because of higher rates, because of those higher real yields. But the question is sort of what happens with inflation. It's still an open question. It's clearly decelerating. And the bet is, does it re-accelerate as we get into the end of the year? That's an unknown. And then secondly, the technicals behind the Treasury market in particular have been really weak this summer. As we know, the rating downgrade that came from Fitch, a combination of sort of extra issuance and supply, which is going to continue well into next year, and then international policy, particularly out of Japan, all of which makes for a pretty weak technical backdrop. That's all conspired to push up rates and kind of allow us to retest those highs. We think that's actually a relatively attractive entry point because we think the fundamentals will ultimately dominate as we get through this period of weak technicals.
Tony, for many reasons, you agree. I know based on what you've already told us. You go through the reasons, the yield curve confusion at the BOJ. If you're looking elsewhere, you could point to perhaps the commodity market and the rally in crude. Can we talk about that just a little bit more, Tony? How much of a dominant factor do you think this rally in crude has been over the last few weeks, contributing to what's happened in the bond market?
Well, Jonathan, I think it certainly contributes to the narrative that you're going to begin to see the impact on the consumer, which right now has clearly been very, very resilient from a number of different channels, but higher energy prices is one of those channels. So we can talk about how the excess savings are being worked down. We can talk about how the labor market, while still quite resilient and strong, job growth has decelerated from 400,000 per month last year to 200. When we look at the energy market, that is beginning to reflect itself in the pump price that people are paying. So we think as we look forward, you're going to begin to see some moderation in that very resilient consumer spending strength. And so that's where I think the energy price story is going to play in the most, is on the impact on consumer spending as we move through the year.
A key test for that is retail sales tomorrow morning. Then we'll get a view on the Federal Reserve and FOMC minutes coming up on Wednesday. Lots of retail earnings through the week as well. Let's catch up with Ira Jersey of Bloomberg. Ira, before we get to the rates market, talk to me about the data, what you and the team are looking for from retail sales tomorrow.
Yeah, so we're going to be looking at the control group of retail sales. That tends to be the GDP input. That's slowly been coming down, but it's still reasonably robust. The expectation is for 0.5% for the control group. If we see anything above that, then I think we can retest those yield highs in 10-year yields for sure. And then the minutes, obviously, on Wednesday are going to be incredibly important to the market, just not so much for the high-level data, but for some of the nuance and details. What is the Fed's reaction function if inflation, does continue to ease, but we don't get we don't necessarily get a hard landing. So, what is the Fed's reaction function as to when they'll actually start to cut rates?
Ira, this bond market move is getting tons of attention. I said earlier this morning, you asked 5 different people what the reason is for the sell-off. They'll give you 5 different reasons, and we can pick out a few of them together. Yield curve confusion at the BOJ, additional supply, debt downgrades, commodity rally. For you and the team at the moment, Ira, what do you think is the dominant reason, the dominant factor underpinning this move?
Well, it's not inflation. It's not inflation and inflation expectations. Just look at inflation break-evens. They've hardly moved. It's all been about real yields, and that tells me that it is more of the supply and the monetary policy story. It is all of those things, and it just happened to be occurring during a time when the market is fairly illiquid. You have people going on vacation. You don't have dealers wanting to take a lot of risk. And you still have the market leaning pretty short, which means that you can continue to see the yields edge up toward the cycle highs of last November, but then we can wind up seeing a pretty dramatic pullback as some of these shorts wind up getting covered later. Because remember, with yields as high as they are, it's difficult to be short for a long period of time because your carry is so negative, because you have to pay that 4.2% where the 10-year yield currently is, as opposed to receiving something that on the other side.
Ira Jersey of Bloomberg Intelligence. Ira, thank you, sir. Yields up this morning on a 10-year by 3 basis points, just short of 420. On a 2-year up by 5, 494. 494 on a 2-year. 12 months ago, we were asking Fed officials, what's the biggest risk right now? Doing too little or doing too much? There was a view that doing too little was the biggest risk right now, with inflation perhaps threatening to approach double figures. 12 months later, different story. When you sit here now, George, what's the biggest risk? Backing off too soon or holding too long?
Biggest risk, in our opinion, is over-tightening. We're at the point in the cycle where each incremental move, will have meaningful repercussions. It's the danger zone, if you will, for policymakers. And as we just pointed out, and as my colleague on the show also mentioned, inflation is coming down. We're pointing in the right direction. And so the data, we're maybe getting some false signals regarding how strong the economy is. There are many mounting kind of headwinds, all related to the higher cost of debt, even the consumer starting to show some cracks. So in our opinion, the risk is of over-tightening at this point in the cycle, and that they could sort of just sit on hold for an extended period of time, not do much at all, kind of talk the market through. And again, going back to what I said at the beginning, allow these very positive real yields to kind of work their magic. They're not quite as, sort of spectacular as a meaningful rate rise, but they do have a considerable impact on economic behavior as we move through time. That would moderate growth, and that should also bring down inflation at a slow and relatively consistent pattern.
And Tony, is that the conversation you expect to see play out in the minutes later this week?
I do. I mean, there's definitely some disagreement on the Fed between the hawks and the doves. But at the end of the day, we do think that policy has gotten to we'll call it equilibrium restrictive level. We think that as we continue to see some moderation inflation, that restrictiveness increases. So those real yields begin to bite harder as we move through the balance of this year. So we do think the risk is that they over-tighten if they become too aggressive, because right now we think all of the forces are in play for inflation to continue to moderate, albeit slowly. And we think the growth slowdown will be more obvious to the market and investors as we move into the fourth quarter than what we've seen so far from a growth perspective.
So, Tony, why are people calling for rate cuts to start in June? Bank of America, Mike Gapen, Q2 2024. Then you hear the same from Goldman Sachs, Q2 2024. What is it about that kind of period, the middle of next year?
And I think the key there, Jonathan, is that you really begin to see the impact of those Fed rate increases bite as we move towards the end of this year through the first half of next year. In addition to that, you have the global growth pressures that we're seeing reflected primarily in China, where we don't see those alleviating anytime soon. So as those come together, as we approach the beginning of 2024, that's when the Fed can start to look ahead. And if we're correct that by the end of 24, inflation core PCE should be back below 3%, that'll begin to open the door for the possibility of the Fed beginning to cut rates. We think it'll be late in the second quarter. We think they'll be slow to cut rates, but that they will begin cutting because it's staying at this higher level that is ultimately going to be the key to getting that inflation rate down closer to their target.
George, is that the name on the calendar as well, June? Is that circled for you as well, next year for 24?
It's a good question, Jonathan. It seems as we've seen over the cycle, the kind of rolling 6-month forecast expecting kind of the sort of material slowdown as well as the rate cuts that come on the back of that. So I think this is sort of conveniently pushing forecasts about a little over, but about 6 months forward, saying sometime in the second quarter of next year, is when we're going to see that. That's not necessarily our view. We think we could be at this kind of extended period, all going back to inflation. If we're allowing inflation to come down organically, that takes a very long time. So we're not committed that it's this magic period of second quarter of next year, but we do expect kind of this ongoing slowdown in activity that just actually allows the Fed to be patient. And I think that is one thing that the market has a hard time with, accepting that the Fed will sit still. One thing that we would disagree with is that once the Fed does start cutting rates, it's likely to be because of something material, and it's unlikely to be sort of a slow, gradual decline in rates. When they cut rates, it's usually because there's a material problem in the system. So that point, I think we would really push back against and suggest if they're cutting rates, they're probably going fast and furious, and they would be taking rates down materially at that point.
George Bory, Tony Rodriguez, the two of you are going to be sticking with us. We need to talk about China in a moment. Bit of tension out there at the moment. Look at China. Downside surprises around economic growth. We're talking about a bond market selling off stateside treasuries. Talked about this a few times this morning. 8-9 years ago, if you woke up to negative news out of China, the bond market would be rallying, crude would be selling off, copper would be underperforming, crude would be down. Waking up today, more negative news out of China, it's the other way around. Last 3 weeks, the last month, the treasury market's been selling off, not rallying, yields are higher, and crude's up. Crude's not down. Crude's up in a big way since the middle of June, up by more than 20%. We'll return to that story in about 5 minutes' time. Let's get you some movers going into the opening bound. That opening bound about 20 minutes away. Here's Abby.
Indeed, John. And one stock that is absolutely soaring in the pre-market, U.S. Steel. It is up more than 30% after it rejected a greater than $7 billion buyout offer from Cleveland-Cliffs. Instead, it's saying it will begin a review of strategic options. Clearly, the company's in play, and actually, it's off those highs. It's now up a mere 25%. Tesla down 2.8%, weighing on futures on the news that they're lowering prices of some EVs in China. And then we have PayPal up about 2.5%. We do have a report from CNBC that PayPal is naming into its Alex Chriss, their new CEO, would replace Dan Schulman. And if you recall, John, in the latest report, operating margins came under pressure. So perhaps this is one fix that investors see if it is true. Again, that's a CNBC report.
Abby, thanks for that. Coming up on this program, mounting risk to China's economic recovery.
China is suffering from a lack of consumer confidence. It's very clear. Savings are skyrocketing. We need to see some more constructive policies out of China.
Growing concerns over China's real estate market. That conversation up next.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From New York City.
In London, in Sydney,
from Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
China is no longer going to be this big factory for the U.S., so that's changed in China. The Chinese consumer is not the American consumer, and that's especially true with the problems that are going in real estate. You've got this internal problem that they've been working on for 2 or 3 years that's failing. Well, you can either keep trying to fix what's not fixable, or you expand.
That was Academy's Peter Cheer, mounting concerns over China's real estate market with troubles at Country Garden Holdings in focus yet again, seeking to extend a maturing bond for the first time ever and halting trading in local notes. JP Morgan sounded the alarm, writing this: "We see higher risk of contagion, not only across the sector, but also possible spillover to the wider economy." Tom Orlick joins us now for more. Tom, let's talk about this a little bit more. This real estate developer, what's happening there is one thing, what's happening with a wealth manager is another. Is this all about the real estate market in China?
Well, to quote Barbie, Jonathan, some things are happening that could be connected. First, we've got Country Garden, one of the biggest developers in China, and so also one of the biggest developers in the world, on the brink of being unable to service their debts, on the brink of default. Now, at the same time as that, we've got one of China's biggest trust companies. Trust companies in China are shadow banks that take money from rich investors and channel it into high interest rate loans, often to property developers. We've got one of China's biggest trust companies unable to make its investors whole. And of course, these two things are related. As the property sector turns down and big property developers are unable to service their debts, that increasingly is going to mean that financial companies, in this case a trust company, are unable to make whole their investors. If the problem gets more serious, we could see China's small banks unable to make their depositors whole without tapping their capital or getting support from the government.
So, Tom, how ring-fenced do you think this actually is currently, and what kind of risk does it pose to the economic recovery, which has stumbled so far this year?
On the economic recovery, Jonathan, one of the remarkable things about China this year is that even though they face really, really serious problems in the real estate sector, they're still quite likely to hit growth above 5% for the year. Now, of course, the real truth there is that 5% growth is an artifact of the catastrophic growth they had in 2022. It's all strong growth from a low base. But at least in terms of the headline number, 2023 growth is going to be okay. Now, on the bigger question, are China going to be able to ring-fence this problem? Well, so far, there doesn't seem to be much of a desire to ring-fence defaults by real estate developers. Evergrande defaulted, that was big news. Guess what? Country Garden is a much bigger real estate developer than Evergrande was, and so far policymakers do not appear to be running to the rescue. Where would the ring fence come in? Well, my instinct is that the Chinese government has to stop the rot at the banking system. Can some trusts fall over, some shadow banks? Yeah, I think that's probably okay. That can happen without tipping the economy into crisis. Can banks fall over? Probably not. So that is where I would be looking for Beijing to step in with a fix.
Hey, Tom, let's catch up again later this week. Tom Orlick there of Bloomberg Economics on the latest here. George Bory, Tony Rodriguez back with us. Tony, there is what I would describe as some kind of uncomfortable calm around this story in China. We seem to be isolated, disconnected from it, yet we pay attention to it every single day. Tony, what kind of risk does this pose to the U.S. economy?
Well, Jonathan, as you know, the U.S. economy is a relatively closed economy, so it's not going to be a dramatic impact, this quarter, for example. But that weakness, that impact to global growth that'll come from the Chinese economy decelerating from what we do agree is likely to be a 5 handle on growth for this year. We think next year it'll be below 5% and continue to decline over the course of the next few years. That weakness in global growth is going to be part of the narrative that really allows U.S. inflation to continue to moderate as global growth sees that weakness. But the Chinese economy has had these imbalances of being overbuilt and over-leveraged in real estate. We think that the government wants to see some of those imbalances reduced, so they're not going to have an aggressive response strictly to the property sector, but they are going to try to maintain, reduce social unrest risks, maintain the stability of the financial system, and have growth moderate slowly below that 5% level over the next few years.
George Bory, final word here.
Yeah, I think the important thing to remember is that, China is no longer kind of the exclusive exporter to the U.S. And that's really sort of what the impact, we think, is. Countries like our neighbors to the north and neighbors to the south, Canada and Mexico, kind of benefit as China needs to sort of, kind of deal with fiscal policy that's not really working as expected. They can't continue to sort of stimulate like they once could. And the transition to a consumer economy, it's happening, but the Chinese consumer is very different than the U.S. consumer. And so it doesn't sort of unfold in the same way. But kind of the big shift is the demand function. The U.S. is kind of pivoting to other suppliers of goods and services. And, that's why our economy, we think, is holding up reasonably well, while the Chinese continue to kind of work through some of these challenges.
George Bory, Tony Rodriguez. Tony, George, great to catch up with you both. Thank you. I asked this question a little bit earlier on this morning. What's the biggest risk right now for the Fed? Backing off too soon, holding too long. Neil Dutta of Renmac in my inbox just moments ago. I continue to see the primary risk for markets that the Fed takes its feet off the brakes too soon. I'll bring you the fuller quote in just a moment. Coming up in the morning calls and later, Seema Shah of Principal Asset Management making a case for limited equity upside from current levels. That conversation up shortly.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Treasuries down, yields up, dollar stronger, equities struggling just a little bit over the last couple of weeks, including this morning. We fade, equities down by 0.2%. That's the price action. Let's get you some morning calls. First up, Morgan Stanley reiterating Nvidia as their top pick, saying the recent sell-off has created a good entry point ahead of next week's results. Your second call from Bernstein, downgrading Marriott to market perform, recommending investors buy shares of Hyatt instead, given the stock's compelling valuation. And finally, Barclays downgrading Mosaic to underweight, seeing limited upside after outperforming the first half of the year. Coming up on this program, a big week ahead for the consumer, retail sales and retail earnings. Seema Shah of Principal Asset Management up next. Your opening bell just around the corner.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
2 weeks of losses on the S&P 500, no sign of a bounce. Equity futures down by about 0.2%, fading away from the gains earlier on this morning. For the Nasdaq, really interesting moment. Back-to-back weekly losses on the Nasdaq 100 for the first time this year. If this one closed right here for the month, the Nasdaq 100 down by close to 5% for August so far, it would be the worst month of 2023. From New York, there's your opening bow. Switch on the board and get to the bond market. Over the previous 3 weeks, we've climbed 30 basis points on a 10-year yield. We add some. We add another 3 basis points and approach 420 on a 10-year at 418.55. Getting back to that level. Getting very close. The post-SVB failure high in the bond market. The cycle high for this cycle, pre-SVB, back to October, about 430. Getting closer, aren't we? Off the back of that yield move, dollar stronger against everything in G10, including the euro. The euro a break of 109. We're negative by 0.6%. On the euro right now, 108.87 against the dollar. And in the commodity market, that's another curious one. A rally of more than 20% from the middle of June. We take some back. We're negative 0.75% at $82 and about 60 cents. About 50 seconds into the session, we're negative here by 0.2% on the S&P. On the Nasdaq, we're down by about 0.4. One stock to watch at the open is US Steel. Shares surging after rejecting a $7.3 billion takeover bid from rival steelmaker Cleveland-Cliffs. US Steel calling the offer, quote, unreasonable, despite representing a 43% premium to Friday's closing price. Abby has more. Hey, Abby.
Hey, John. And this has the stock on pace for its best day ever, going back more than 3 decades since it was first a publicly traded company back in 1991, up 25%. So clearly the company and the stock are in play. The fact that they rejected that unsolicited $7.3 billion bid from Cleveland-Cliffs suggests that perhaps they think, and also that language you were just talking about, unreasonable, suggests that maybe they think that they can get more. Apparently there are other offers on the table. The board acknowledged the receipt of a number of those offers for parts or all of the company. So it's very unclear what strategic alternative they will in fact pursue. But one thing is clear. This was a $200 stock back in June of 2008. In the depths of the pandemic, it was a $4.54 stock, as in $4.54. So down tremendously. The board and investors are probably looking to unlock value right now at roughly $29. It's close to the highs over the last decade or so, John. But again, investors probably wanting to unlock more from U.S. Steel, and the fact that there are suitors out there suggests that they will be successful in doing so perhaps this year.
Abby, thank you. That stock is up by more than 26%. Here's another one for you. AMC wins court approval of a stock conversion plan, clearing the way for its recapitalization efforts as it faces possible bankruptcy. Simone Foxman has the story. Hey, Simone.
Hey, John. Yeah, the shares down the most in well over 2 years after a judge approving the settlement that it had reached with shareholders after the bell on Friday. This stock conversion plan, they want to increase the number of shares. It contemplates also, it says that the company will also convert those private equity units into common shares as of later this month. The whole idea is to shore up capital reserves, pay down debt, and invest in growth plans. Judge Morgan Zern, in Delaware Chancery Court, approving that plan late Friday. There were some concerns that this would dilute the shares of common equity holders, but she found that giving them additional shares mitigates these concerns. We are seeing the impact of the dilution of these stocks, however, in the market this morning. These private equity units, preferred equity units, catching up, narrowing the distance between those common shares. They are rising today.
Simone, thank you. AMC, they're down by 34%. I want to draw your attention to this one. Hawaiian Electric Industries plunging at the open here in US trading off the back of some concern that its power lines may be linked to the deadly Maui wildfires that we've all witnessed over the last week or so. That stock is getting absolutely hammered at the open. One to watch through today on Bloomberg TV and on Bloomberg Radio. Let's turn to the auto sector. Tesla rolling out a new round of price cuts in China, according to a post on its Weibo account, reigniting fears of a price war following similar moves by a host of automakers in Asia just last week. Ed Ludlow has more. Morning, Ed.
Good morning, Jonathan. Tesla is down more than 3% at the open. The trim in China is $1,900 US to the Model Y long range and performance. That equates to a 4.5% trim on the long range and a 3.8% trim on the performance. And as you and I have discussed on this program, you know, using the lever of price cuts has been normal for Tesla in the first half of 2023. The concern, though, is twofold. As you point out, a note from Evercore and Chris McNally saying that this could presage cuts in other regions, like in the United States and Europe, and in turn lead to a price war for EV players globally. You look at the market reaction in China, names like BYD, falling, Li Auto, XPeng, all seeing their Hong Kong or China-listed shares impacted overnight. Here in the US, other pure play names like Rivian and Lucid are also lower at the open. The second concern that analysts will have is Tesla's bottom line and the impact of further price cuts on gross margins. Remember, when the mix of Tesla's deliveries is skewed towards domestic China deliveries, it has been supportive of margins in the past, but Elon Musk and Tesla's position has been very clear. They're willing to sacrifice the bottom line, use price cuts as a lever to open pockets of demand at lower price points in order to protect that target growth rate of 50% annual growth year on year. It's a common piece of Tesla's playbook, Jonathan.
Volume over margins, he's talked about it continuously. Ed, just briefly, is this more about the global EV market, or is there something specific about China and some of the weakness there for that industry?
You know, we talk about this so often about how in China there are many more domestic players offering a much wider range of pure battery electric options to consumers. It is a more competitive market. The 3.8% trim on the performance or 4.5% on the Tesla Y long range is in line with prior cuts. It's not a severely deep cut to prices. And indeed, if you look at the cuts of the first half of the year, some of them have been much deeper, higher single digits or even double-digit cuts here in the United States. So that bear that sort of uniqueness of the China market in mind.
Ed, thank you, sir. Let's stick with EVs. We can do that this morning with Nikola announcing plans to recall over 200 trucks and temporarily stop sales after several battery fires. The CEO stating, at Nikola, we take safety very seriously and will continue our transparency as we learn more. Katie has the story. Hey, Katie.
Hey, John. Yeah, to get specific here, the EV maker is calling back about 209 of its Tre trucks. That's after a third-party investigator found that a coolant leak was the likely culprit behind a fire at Nikola's Phoenix headquarters back in June. And in addition to that recall, like you mentioned, Nikola is also going to temporarily pause its sales. It did say that its vehicles can remain in operation, but it advised its customers and dealers to park outside until a fix is ready. I don't know if that's reassuring. You can see the shares currently off by about 12%, and today's plunge follows a pretty stellar run for the shares. Actually, if you look at the past 3 months into Friday's close, Nikola shares were higher by about 154%. But zooming out for the context, Nikola is down over 80% from its 2020 IPO, John.
Katie, thanks for that. About 8 minutes into the session at the moment, equities are lower. No drama here. We're down by 0.2% on the S&P. On the Nasdaq, we're down by 0.3. For those of you who like round numbers, very, very close to 420 on a 10-year. The higher the session is right now at 419.92. We're getting closer and closer. There is a sell-off in the bond market. There's been one over the last month, over the last 3 weeks, a 30 basis point move on a 10-year. Yields are up today on that maturity by 5 basis points to just short of 420. On a 2-year, up 6 basis points there to 495. Yields just pushing higher over the last month or so. Seema Shah of Principal Asset Management recommending investors stay flexible given the changing macro environment. She writes this: as the economic slowdown moves closer, our positioning will be adjusted to take advantage of the emerging opportunities. We shift equities from slight underweight to neutral, given a US recession, and any equity pullback will likely be short and shallow. The following recovery will likely be swift, requiring a nimble and active response from investors. Seema, I'm pleased to say, joins us now. Seema, I want to begin in the bond market. 420 on a 10-year on my screen right now. We're through that level. On a 2-year, we're up 6 basis points to about 495, 496. Seema, what's behind this move in the bond market over the last month?
You want me to give you one of the 5 different answers you've already had?
Please do.
Well, look, from our perspective, it's really these I guess the key thing is about expectations for a soft landing. And with that, there's rising hopes that maybe, or rising concerns, in fact, that inflation could end up being stickier, leading to maybe further Fed hikes down the line. So not talking about in the immediate future, but further down the line that maybe the Fed loses control of the inflation fight. Now, I've got to say, I do not buy into that. I think that we're going to see a drop in yields as you get closer to an economic slowdown. I think the inflation story will be, maybe it's not going to go back down to 2%, but it will be contained. So I think that this is actually an opportunity to add duration, rather than being too concerned where exactly this is going to go.
So at the 10-year, at the 30-year, how long along the curve are you going to go, Seema?
So I think you can look a little bit at the belly, but further out as well. So really on the 10-year point, I won't be looking at the short end for right now. We are expecting rate cuts in 2024, not this year, so that's a little bit further out. So it's really at that belly and 10-year point that we'll be adding duration.
Seema, this has been happening with a rally in the commodity market in the background as well. One question we've got coming into this week is just on retail, on earnings there. How resilient is the consumer against the backdrop of commodities starting to increase again and rates still at pretty elevated levels?
So look, they're clearly resilient today, but that doesn't mean that they're going to stay resilient going forward. So we do think the headwinds are starting to build up. You've obviously got the excess savings, which I know has been a narrative for a while, but it is now starting to come through, where the excess savings is starting to be exhausted. And by the end of this year, we do think that consumers will be having to dip into credit cards and really to pull back on spending. The other part of this is, of course, the student loans. And then, as you said, inflation, food prices, oil prices, all of these things are going to be cutting into consumer spending. It has taken a while. I would argue, I know that from other people that they believe that the lags have been very short. I would argue that the lags have actually been extra long this time. And one of the reasons is this huge amount of excess savings that has helped cushion consumers and actually to some extent corporates as well.
With that in mind, Seema, when we hear from the likes of Target, Walmart later this week, Wednesday, Thursday respectively, do you expect to hear more about trading down and less about pricing power?
I do. I think pricing power is really becoming an increasing issue. And in fact, when you start to think about how to invest, it's not necessarily about sectors or styles or anything like that. It's really about focusing on which companies do have that pricing power. As inflation continues to come down, as you get an economic slowdown, which are the companies going to be able to withstand those kind of economic pressures? So yes, I do believe that that's going to be an increasing narrative going forward, not just this, of course, earnings season, but the next one's coming up.
So I take it you wouldn't be a buyer of this story of the equity market continuing to broaden out and to buy this cyclical play, not just in bonds, but also in stocks?
I don't buy into it. Look, I think that there is a lot of very positive investor sentiment. The soft landing has really become the consensus view. So there is going to be some broadening out. Now, how long that can be sustained, I think, is very questionable. Because, as I said, we are expecting the economic downward forces to start kicking in through Q4. Whether you want to call that recession or a slowdown, I think it's somewhere in the middle of that balance. But that will mean that things like small cap will be challenged. Now, for us, I have to say, once you start to see those challenges and once you start to see the labour market start to unwind a little bit, then that will be the best opportunity to increase your exposure to things like small cap. I don't think this is the right timing, but there will be opportunities in the coming quarter or next 2 quarters where you can start to put a lot of that money to work.
Russell down today by 0.8%. Seema, I promised a fuller quote from Neil Dutta of Renmac earlier on in the programme. I want to share it with you because it's almost a counterpoint to the kind of things that we're talking about currently. He says, I continue to see the primary risk for markets as the Fed takes its feet off the brakes too soon. You either believe a period of below potential growth is necessary to quell inflation or you don't. He says, given the inflation tailwinds from housing, motor vehicle, airplane assemblies, inventories and consumption, the US economy is nowhere near a below potential growth situation. He goes on to say and finishes with this line, the Fed continues to breathe life into the idea that rates might be cut early next year. Not good. Seema, what would you say back to that?
God, I have a huge amount of respect for Neil, and he makes some really strong points. We're somewhere in the middle there, actually. But what we're saying is that although the economy is resilient today, it's going to slow down. And we do buy into the idea that you need to have an economic slowdown if you're going to take out the firepower behind inflation today. But we think that's going to come down slightly down the line. So for us, the Fed stays on hold right now. You do start to see rate cuts coming through in Q1 of next year, late Q1, as some of those recessionary fears start to actually come to fruition. But I do buy into a lot of what he's saying, that look, the economy is very strong. The Fed does need to keep very, very aware and on top of that data. But to us, that means keeping rates on hold where they are rather than raising them further.
Seema, thank you for the update. Seema Shah of Principal Asset Management. Her views on the equity market, how they contrast with the likes of Neil Dutta and others, just subtle nuances. About 14 minutes into the session, let's go cross-asset together. Equities down just a touch. In a bond market, much more interesting moves. Treasuries down hard. Yields up 6 basis points on a 2-year, 4.96. 10-year, in and around 420 right now at 5 basis points. So yields higher, push that through the FX market. Dollar, a whole lot stronger. Euro dollar, negative by 0.6%. Session lows, break of 109, 108.82. Coming up, also about a week away, debates for presidential candidates. They're taking a swipe at Bidenomics.
Bidenomics is a failure, despite all the happy talk coming out of Washington, D.C. You can tell there's an election coming up because all of a sudden Democrats at the White House are telling you how their policies are all working. But we have a national debt the size of our nation's economy.
That conversation up next.
Covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Global economic pain may turn into emerging markets gain. Investors say they plan to allocate more funds to emerging markets over the next year. That's according to the latest Bloomberg survey of professional and retail investors. More than 60% of respondents are betting emerging markets will either push higher or outperform the developed markets if the U.S. economy tips into recession. This would mark a significant change in leadership that's been in place for more than a decade, in which U.S. stocks have returned more than 700% since March 2009, dominating the rest of the world. Within EM, market watchers rank stocks as the best investment, followed by a tie between debt in local currencies and U.S. dollars. Lower valuations is a big draw. In equities, the MSCI Emerging Market Index trades at 12.5 times estimated 2023 earnings. By contrast, the S&P 500 has a multiple of more than 18.5. External factors may end up proving to be bigger influences on emerging markets than domestic politics. The dollar's weakening trend means companies in emerging markets should have more room for growth, and countries that did not prop up their economies with stimulus during the pandemic may be better positioned to return to a growth rate that's sustainable. Looking out over the next 2 years, respondents overwhelmingly made Southeast Asia their top pick, beating out Latin America and Eastern Europe by a wide margin.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Bidenomics is a failure, despite all the happy talk coming out of Washington, D.C.
I define Bidenomics as the poor get poorer.
When I take a look at the Biden administration and where they're headed in the wrong direction, I don't just mean course correction, I mean a 180-degree turn.
Republican presidential candidates taking a swipe at guess what? Bidenomics. The president leading an administration-wide effort to celebrate the one-year anniversary of the Inflation Reduction Act, traveling to Wisconsin Tuesday and hosting an event at the White House on Wednesday. Vice President Kamala Harris highlighting the IRA's clean energy tax credits in Seattle, while Secretary Yellen delivers remarks from Las Vegas later today. Writing in comments released on Friday, workers are better off than they were last year. Real average hourly earnings have grown over the past 12 months, meaning that wage gains are outpacing inflation. Let's get you some team coverage. Kelly Lyons and Mario Parker. Mario, that's what they're selling. Is the electorate buying it?
No, not right now, Jonathan. The electorate is not buying it, even though Biden is touting it and as of right now pinning his White House reelection strategy on the economy. Voters give him poor marks on it, and that, as you mentioned in the segment prior to this one, this is why you see Republicans attacking him for it on the campaign trail.
Kaylee, why is it falling on deaf ears?
Well, this is the question, John. I spoke with Cliff Young, the president of U.S. Public Affairs over at Ipsos, which is a polling firm, and he essentially said price pressures may be easing in terms of the extent to which prices are going up, but Americans are still feeling pinched in their pocketbooks, and as a result, they're feeling surly about the economy. So as the Biden administration is touting how great things are, people aren't necessarily feeling great in reality, which may be why there is this disconnect between what we are seeing in economic data and what American people are suggesting they feel about this administration. Hence this 10-state tour that the president and his surrogates are embarking on, really trying to double down on the messaging that they have been good stewards of the economy through legislation like the Inflation Reduction Act. And we have to consider what states they are traveling to here as well. Janet Yellen, for example, speaking late this afternoon from Las Vegas, Nevada has the highest unemployment rate in the country, 5.4%. But at the same time, as you read there, her talking about wage gains outpacing inflation in leisure and hospitality, which is huge in Las Vegas. That is where some of the wage gains have been the strongest. So perhaps that's why she's doubling down on that messaging there. And we also expect her to say, according to her prepared remarks, that she does believe there is a path to continuing to reduce inflation while maintaining a healthy labor market. John.
Mario, we heard there from Republican candidates. We've heard there from Kaylee what we're likely to hear from the Treasury Secretary. I think we know what we're going to hear from Republican candidates on this issue as well on the debate stage next week. Mario, what we don't know is who will be on that debate stage. And one man in particular hasn't really shown his hand. Mario, is the former president going to show up or not? And how close to the event do we need to know by?
Well, he has to let the RNC, the Republican National Committee, know within 48 hours. We're talking about, of course, we're alluding to one Donald J. Trump, the former president, who is also a former reality star. So he's trying to keep us on the edge of our seats as to whether or not he's going to show up, right? Polls show, to Kaylee's point, polls show that he has a wide lead over the rest of the field right now. So it may not make sense strategically for him to show up at the debate. From what I understand from sources within Trump world, it's 99% certain that he will not debate. They're holding out that 1%. Now, that 1% is loaded because we're thinking about that ego that Trump has and whether or not he wants to cede the stage to some of his competitors and essentially cede the spotlight as well.
That's an important 1%. Mario, thank you, sir. Alongside Katie Lyons, to the two of you, thank you. The team coverage down in Washington. Let's return to the markets about 22 minutes into the session. Equities just a touch lower with some sector price action. Here's Abby.
And relative to those sectors with the S&P 500 down ever so slightly, we have more sectors lower, but mainly small moves to the upside and downside. The worst sector on the day, utilities down. Actually, it's a greater decline at this point, down 0.9%. That's actually, in a way, risk on, only because that's a defensive sector that is suffering because of yields being higher. On top, we do have two of the mega cap tech sectors, tech and communication services, both up less than 0.5%. Over the last month, though, John, it's really interesting because utilities, this is one of the worst sectors, but so too is technology and consumer discretionary. So we really have this picture as the 2-year yield has backed up by 20 bips and the 10-year yield by 40 bips. Sectors getting hit on all sides, both safety and offense.
Abby, thank you. Your trading diary up next.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
At 25 minutes into the session, early days, but small caps getting hammered at the moment. The Nasdaq just about positive, and the S&P down by about 0.1%. That's the price action. Here's the trading diary. Coming up 5 p.m. today, Yellen, the Treasury Secretary, discussing the Inflation Reduction Act in Las Vegas, Nevada. U.S. retail sales coming on Tuesday, plus some Fed speak in the mix as well. Target reporting results before the opening bell on Wednesday, plus the Fed minutes coming on 2 p.m. on Wednesday too, followed by Walmart earnings on Thursday, along with another round of initial jobless claims. From New York City, looking forward to covering the week with you all. Get my words out. This was the countdown to the open. This is Bloomberg.
is crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities.
Could face bigger challenges.
What's next?
Fed was going to keep rating World Cup. This is a 3.
As the economic picture done.
Is it the OK's getting ready to make a decision?
This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. A little bit of red on the screen for the equity futures, as Matt was just pointing out to me. How about the U.S. dollar? The Bloomberg Dollar Index up 0.5% here today. Trouble in emerging markets like Argentina. Got some weak numbers coming out of China.
Plus strength in the U.S., plus really high yields. I mean, our real yields now, the 10-year minus inflation is 1.8%.
Yep.
You can buy more than 145 yen right now.
That's not bad. And look, we got an M&A trade involving U.S. Steel. Whoever thought we'd see that? Richard Borky covers all the steel stuff for us at Bloomberg Intelligence. He'll join us in here. Plus, Dan Ives calling in from Crete on technology. Why is he calling in from Crete? I don't know. We asked him. And then Ethan Devitt, CIO at Moneta. She's going to join us to give us her market call here. But let's kick things off and get a Bloomberg Business Flash with Amy Mars.
All right, thanks, guys. China also moving to address a worsening property slump that continues to deteriorate. Bloomberg China economy editor James Mager is in Beijing and says housing is the biggest issue facing China's economy.
It's been two and a half years now that the housing sales have been falling, that developers have been slowly going bankrupt, and some of them have been defaulting. And there doesn't seem to be any end in sight for the problems that the housing developers and housing buyers are facing right now in China.
Bloomberg China economy editor James Mager in Beijing, a guest on Bloomberg Daybreak. Tesla also cutting prices in China on their Model Y. Tesla shares down now nearly 3%. We check the markets all day long right here on Bloomberg Radio. The Dow is down 0.1% or 19 points. S&P 500 little change, down about 1.5 points, and NASDAQ little changed, down 1 point. The yield on the 10-year now at 4.20%. The 2-year yield at 4.95%. NYMEX crude oil down 0.6%, or 56 cents, now trading at $82.62 a barrel. Brent crude down 0.7%, or 65 cents, trading at $86.16 a barrel. COMEX gold at $1,935.80 an ounce. The euro at 1.0884 against the dollar. British pound at 1.2631. And that is your Bloomberg Business Flash, guys.
All right, Amy Marsh, thank you so much. We appreciate that. Looking at this market again, as Amy is just reporting, a little bit of red on the screen, not too much here. We're waiting for some more economic data to cross the tape later on this week, perhaps. But let's see what's happening underneath the hood. Lots of stock-specific names out there. Bailey Lipschultz, he covers all the markets for us. He joins us live here in our Bloomberg Interactive Brokers studio. Bailey, what are you looking at?
Yeah, as you mentioned, a little bit of red, not too much pressure on either side. Not a lot standing out on the up and downside in the S&P 500, but when you look at a stock like PayPal up 1.4%, that's coming after naming Intuit's former leader Alex Chriss as CEO. So a new name for PayPal. Obviously, they have had a fun time. Another stock that's under quite a bit of pressure, though, Hawaiian Electric down 40% right now. Yeah. This tumbling as lawyers investigate the cause of the fires out in Hawaii. And another stock, obviously, as you mentioned at the top, Paul, U.S. Steel right now up 27%, rejecting that takeover offer from peer Cleveland-Cliffs. We're seeing steel names outperforming. Big interest.
How do you reject a takeover offer like that? The first thing I thought when I read this story, somebody offers you a 43% premium in this market.
You hire some bankers, and they do the comps, and they see where the comps are trading, where you think your earnings are going to be, and yeah, it's a 43% premium, but maybe 2 years ago, you were trading at 3x your current stock
price. But it isn't 2 years ago. It's now. And if your company was worth $32 a share now, it wouldn't be traded for $22 a share.
You would think. But in a change of control, a whole nother bunch of attributes come to play. And if you're a good investment banker, you say, no.
I think it's interesting that the stock hasn't rallied up to the offer price.
There you go.
So the offer price, Bailey, was what, like $32 and change, right? And I know part of that is Cleveland-Cliffs stock. But so far, U.S. Steel is only up to $28.72. So they haven't proven to the market that they're worth as much as the offer on Friday.
Yeah, but it is interesting to Paul's point. They hired Barclays and Goldman as financial advisors for the strategic review. So sell part of it and sell all of it.
Yeah, they're not trying to figure. They're going to spend more money to try and figure out how they can get out of this deal that Cleveland-Cliffs is offering them.
All right, so let me give we're going to have Richard Bork from Bloomberg Intelligence. He'll be in later to give us all the details of what it means in the steel industry. But just for the stock, Matt's favorite, one of his favorite functions, COMP, comp. You put U.S. Steel against the S&P. Over the last 5 years compounded, U.S. Steel is absolutely unched on the nickel. S&P up about 11.3%. So there you go. I mean, so just we'll see if they can get some more value.
You got to put it up against Cleveland-Cliffs.
I know.
So over the last 5 years, U.S. Steel has returned total return negative 0.23%. Cleveland-Cliffs over the last 5 years, total return 59.5%.
Yep. They've been doing some big deals, and we'll talk to Richard Bork about that in just a moment. When I was looking at that story you just mentioned about the Hawaiian utility, I mean, when you think about the videos we were seeing of that storm and the hurricane winds, no kidding this could happen. I mean, I guess it was just, for lack of a better term, a perfect storm on the downside. You get some kind of spark. Where that came from, no one knows at the moment, but boy, you combine that with those kinds of winds, and man. Yeah. So I guess we're going to see a lot of those suits roll in and all the legal things play out.
Yeah, just looking at our story on the terminal, basically saying that the Hawaiian Electric didn't turn off power despite all of that. So dry, gusty winds could create fire conditions. I'm from California. I know quite a bit about fires. So I guess you look at kind of some of the things that have played out there, but not a shock.
Yeah, it's just amazing, the devastation there, and you see the before and after photos and everything like that. So anything else getting your attention at this point?
EV stocks under pressure. Tesla, China price cut. Nikola recalling batteries.
So what's he doing? Why is he cutting prices again?
He's cutting prices in China, first of all.
But I thought he agreed with the Chinese automakers not to do that.
Well, this is the concern, right? That he sparks, that he sort of reinvigorates a price war there. here in the U.S., of course, he's already done it and led to, I guess, a price skirmish, you could call it, with Ford because other people haven't really joined in. But the Nikola story, I think, is funny, right? So they have had to recall batteries or trucks that their batteries are in for fires, but Volvo's already done that. So all of these big truck makers that have made really just a handful of products have had to recall those products to fix issues because any kind of weak third-party link can cause, when sparked, a fire.
And this goes back to Kevin Tynan's kind of issue. It's hard to make cars. Bending the steel, that's the hard part. Having the cool technology, arguably, okay, Elon Musk did that better than anybody even could have imagined, created this, but now you got to make the stuff. And then, recalls and all that kind of stuff. So,
yep.
Interesting. All right, Billy, thanks so much for joining us there. Billy Lipschultz. Nikola off 12.3% today and off 75% over a trailing 12-month basis. So they need some good news over there at Nikola.
98% since they went public via SPAC.
Yeah,
that's
exactly
the amount that they've lost.
Yep, just extraordinary. All right, let's talk about X. Still one of my favorite stock tickers of all time.
One of the best stock tickers of all time, and Elon Musk wants that ticker.
Exactly.
So I wonder if he does a side deal with Cleveland Cliffs, like, hey, if you guys make this work,
right,
I'll buy the ticker.
Right, exactly. Actually, that's a good question. I don't know where that ticker goes. I guess back to New York Stock Exchange, and then it's up for bid.
Well, you can buy it just like Zuck bought Meta. Right? Facebook used to be FB, and that was obviously a NASDAQ deal, but Zuckerberg bought the Meta name from an ETF operator.
Yes, that's right.
For an undisclosed amount of money.
That's right, but that's because it was still outstanding. But now if you retire X, where does the ownership go?
Well, maybe they make a deal so that he buys it before it gets retired.
Yeah. All right. Rich Bork, he covers all the steel industry.
We're speculating
guys.
a little bit here.
Yeah, we're just speculating, just spitballing here. Boy, I never thought we'd see a deal in there. I guess I wasn't expecting a deal in the steel industry. I don't know why, but it was an interesting transaction. What is Cleveland Cliffs really looking to do here? Why are they doing this deal? Why would they like to do this deal?
I think they'd like to do this deal again, like you touched on. It's back to the 1920s. Where steel is cool again.
Right.
Let's make steel cool. Fortunately, Cleveland Cliffs, most of their plants are from the 1920s.
Okay.
So what they're looking for is obviously they're looking to get exposure to Big River Steel, which is the EAF that U.S. Steel is building.
All right, Big River. What's EAF?
EAF is electric arc furnace.
Electric arc furnace.
Rather than the blast furnaces.
Okay. So this is newer technology to make steel.
Newer technology, more flexible technology. Usually also non-union technology.
Nice.
Non-union run. So if you look at kind of the math, they offer $35 a share, half cash, half stock. The cash portion comes to a little under $4 billion. U.S. Steel has $3.1 billion of cash on the balance sheet. In order to finish Big River Steel, they bought Big River Steel when it was half built, a little over 3 million tons a year.
Okay.
They're expanding to another 3 million tons a year. To get 3 million tons a year of EAF capacity is around $3 to $4 billion. So if you look at it this way, we just offered 50% stock and $4 billion of cash to get a little over 6 million tons of EAF capacity that probably cost us $7-8 billion to go build.
And that's basically what they're bidding, right?
That's basically what they're bidding. Right, on the equity.
But U.S. Steel apparently thinks they're worth more than that. Although they were trading for $22 a share on Friday, why do they fight this? It's a decent premium. Can they get more elsewhere?
I think you take the deal. You have 43% premium today. U.S. Steel has outlined this what they call their best for all plan. So part of it, one part of it is finish building out Big River Steel. Other parts are to upgrade our finishing capabilities. The other part is they're looking to expand in electrical steels, which flow into EVs, which you gentlemen were talking a little bit prior. So they've outlined this plan, but it's a multi-year capital spend program. And we don't see the success, whether it be successful doesn't play out for a few years.
Now, Paul, we've been you know, we've been invited out to see Big River.
I'd love to go see that.
Because David Stickler came in here. He sat right in that chair where you're sitting, and he said, you guys should come out and check out our new plant.
So I guess the issue is, I mean, I'm looking at the CapEx. I mean, for U.S. Steel, they spend, you know, a couple $1 billion a year, $2.5 billion a year in CapEx. Is that money going just for the new technology, or are they still putting money into some of these plants in Pittsburgh and Gary, Indiana, and Allentown?
Right, it's about 2/3, 1/3. Okay. 2/3 for the new technology, 1/3 for the old technology.
And the old technology is just to kind of keep it running?
Try to keep it running.
Wow.
Correct. So the thing here is you have this plan to, you know, both U.S. Steel and Cliffs have been shutting down, rationalizing capacity, you know, closing the old blast furnaces and things like that. That's why...
For environmental purposes, or just because it costs too much to run, they're not getting enough, enough product out of it?
Really costs too much to run.
Right.
And the technology, in order to reinvest in the technology, is just too expensive.
Well, this is what Cleveland Cliffs is looking to do, essentially, right? This is what U.S. Steel is doing at Big River, and Cleveland Cliffs wants to buy that from them.
Right. If you look at this, will take the pro forma company. Cleveland Cliffs probably is 93% blast furnaces today, 7% EAFs, the new technology. This would take them to 80-20. Beyond that, you say, well, gee, that seems not that big of a deal, but it gives them a lot of flexibility, because one of the other things about EAFs is you can shut them off, turn them up and turn them down a lot easier than you can with blast furnaces.
By the way, who are their competitors? Who else in this market could make a bid if, you know, U.S. Steel could be worth more?
Well, you would have Nucor and Steel Dynamics, which are the two other big players in the U.S. They're 100% EAF technology.
They're already there.
So they probably don't care for the blast furnace route.
Right.
You know, you mentioned that David Stickler invited you guys out to see Big River Steel. He built Big River Steel. Now he's moved on to another project, High Bar, which is a rebar plant. But David Stickler also built some of Steel Dynamics' first plant, or was it part of a group that built the first EAFs for Steel Dynamics?
So are new steel mills in the United States being built today?
Well, what's happened is Section 232 has really helped these guys. If you look at the U.S. steel
What is Section
industry,
232?
Section 232 was the Trump laws to prevent imports, putting a 25% tariff on steel import to the U.S. If you look at U.S. steel industry historically is about 100 million tons of steel a year. 80% is produced in the U.S., 20% is historically imported.
Oh, okay.
With these tariffs, that's made the imports a little less competitive. What's happened is we've seen over the last few years, capacity being added in the U.S. to displace the tariffs once they finally, to displace the import steel once the tariffs finally go away.
So the onshoring is actually happening in the steel business?
Yes. Okay.
So, all right, you put these. If you were to put these two companies together, Cleveland Cliffs and U.S. Steel, how big would they be, kind of relative to the world order of steel makers?
It would make them a top 10 in the world.
Okay.
I don't think scale helps you at all, but that's.
Why? I thought manufacturing scale helps.
I
learned that in business school. I know you went to Chicago Business School. You guys are good with the numbers, but
it's just an industry that's, you know, historic. You know, it costs a lot to ship. Right. So why would it be cheaper to build a ton of steel in the U.S., put on a boat to somewhere else in the world?
All right. So what's this deal called today? You talk to institutional investors and the three guys in Pittsburgh that still invest in this stuff. What's the call here? Do I buy Nucor? Do I buy U.S. Steel? What's the investment call for this group?
I mean, if you kind of look at Nucor and Steel Dynamics, outperform these two guys by a wide margin.
And that's the function of the technology that they've advanced.
I think one, function of technology, and two, you've also, Nucor and Steel Dynamics have, over the last few years, been more aggressive in moving further downstream.
All right, one other part of this deal, and I could go to Jen Rhee, because she's the expert on antitrust. Right. What is Jen Rhee telling you about any antitrust here?
There's going to be, I think there's going to be an antitrust review here. Talking with Jen too, she was also, so that's another element of, you know,
another reason why I get a discount
whether the deal goes on.
Yeah, right. I mean, I look at the 5-year performance of, as we mentioned earlier, U.S. Steel has returned nothing, negative 1%, but Nucor has tripled over the last 5 years, and Steel Dynamics is almost there. I mean, they're up 170%.
They made money in steel companies.
Yeah. What are the contracts that you look at for the underlying?
And we got 10 seconds.
What are the steel contracts that you look at for the price?
The price? Oh, if you look at STAN-HC.
All right.
STAN.
All right, we'll get into the steel business.
XW is the hot rolled steel price.
Oh, I got hot rolled steel.
Hot rolled steel.
All right, Richard Bork, thanks so much for joining us. Richard Bork covers all the steel companies and all that good stuff for Bloomberg Intelligence. More coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it. Well, as you've heard here on Bloomberg Markets, United States Steel has rejected a $7.25 billion bid from rival Cleveland Cliffs and will begin a review of its options instead. Bloomberg's Kriti Gupta reports.
U.S. Steel announced a formal process to assess its alternatives after receiving approaches for parts or all of the business on Sunday, with Cliffs going public with its offer just hours later. Now, Cliffs did say it submitted the proposal privately on July 28th and received a rejection letter calling the offer, quote, unreasonable.
U.S. Steel said Cliffs had refused to sign a non-disclosure agreement unless it agreed to the economic terms of the proposal in advance. Now, that deal would have created one of the world's biggest steel makers. Shares of U.S. Steel right now up about 25%. Shares of Cleveland Cliffs up about 2.5%. Tesla has rolled out a fresh round of price cuts in China, triggering worries of rekindling a price war. Bloomberg's Craig Trudell has more on the thinking behind Elon Musk's decision.
It's more a factor of just, the amount of competition in that market, how competitive it is, how crowded it is, and how much the Chinese manufacturers in particular have really proven strong. I think BYD in particular is really bringing up an awful lot of volume and creating a lot of competitive pressure for Tesla.
Now, Tesla shares down about 2%. Shares of BYD down about 5%. And Elon Musk may have one less worry on his plate. Mark Zuckerberg says it's time to move on from any possibility of a cage fight between him and Musk. Now, in a post on Threads, Zuckerberg said if Elon ever gets serious about a real date and official event, he knows how to reach me. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And we are watching shares of U.S. Steel after it rejected a more than $7 billion bid from rival Cleveland Cliffs. Shares of U.S. Steel now up more than 25%, almost 26% now. Cliffs shares up 2.5%. We check the markets all day long right here on Bloomberg Radio. The Dow is little changed, up about 28 points. S&P futures now up 0.1% or 6 points. NASDAQ up 0.3% or 35 points. The yield on the 10-year Treasury at 4.19%. The 2-year yield at 4.95%. NYMEX crude oil down 22 cents at now $83.01 a barrel. Brent crude down 29 cents at $86.53. COMEX gold at $1,940.70 an ounce. The euro at 1.0903 against the dollar. The British pound at 1.2660 against the dollar, and the yen at 145.33. I'm Amy Morris. That's your Bloomberg Business Flash. Matt and Paul.
All right, Amy Morris, thank you so much. We appreciate it. You know, Matt, we like talking to Dan Ives, equity analyst at Wedbush Securities. Pretty smart guy. We usually learn a thing or two when we talk to him. But I don't feel the need to interrupt his vacation, particularly when his vacation is in Crete. Yeah. He's not down at the Jersey Shore. He's in Crete. And we got a video Zoom thing going of him right here because Bloomberg Markets is simulcast on YouTube. You can go to YouTube and search Bloomberg Global News. Dan, I hope you're having a great time in Crete. It looks beautiful behind you. Give us a good sense of what you've kind of just observed just in your time over there.
Yeah, no, it's great to be with you, Matt. I mean, to me, it's always great food, great music. You see some obviously some maybe electric vehicles here and there, but and it's been great, and I think it's just a good sort of rest going into what's going to be an exciting fall.
All right, Dan. So I'm just looking at the bring you back into reality here. The NASDAQ 100 stock index, real tech heavy here, up 38% year to date. Put that stock price performance in context of what we've seen from these tech companies for the first, we just got through their second quarter earnings and kind of the outlook for the remainder of the year. Put that into context for us.
I mean, I view this as just a little sell-off, a pause to what's going to be a rally second half of the year for tech. I think if you look at numbers overall from cloud to digital media to what we're seeing across enterprise, I think it's stronger than expected. Now, granted, the stocks have run significantly. You've seen sell-offs post Apple, Microsoft, Tesla. I think it's short-lived because I think second half numbers look conservative, and we're seeing upticks across the board. That's sort of our view going into the year end.
Dan, where do you think they look most conservative? When you were going over these earnings reports before you jumped on the private jet to Crete, where did you think, these guys are sandbagging us?
I think Microsoft is extremely conservative. I think that's probably the one that sticks out the most relative to what we've seen post-quarter, especially what we see from a channel perspective. I think cloud actually see an acceleration. We saw that with AWS. We see it, I think, with Google as well. I think overall cybersecurity, that's probably the subsector that I think sandbag, I'll call it the most relative to estimates. And that's one where we actually see strength going the second half of the year. And I look at Apple. I think that's one where everything we see from a supply chain perspective is going to be strength from this iPhone 15, not just into September, but into year end. So that's where I really am looking, and I continue to think AI, and we're seeing that the monetization is going to be a lot sooner than expected.
All right, that's kind of where I wanted to go, Dan, AI, because that's been one of the, if not the driving force behind some of the performance we've seen out of these, the NASDAQ 100 and the big tech names. When you talk to institutional investor clients, what's kind of the key question regarding AI that you get from them?
I think the big question is with NVIDIA's guidance heard around the world last quarter, the $4 billion raise. Okay, well, we're not seeing that ramp as quick across software. That's maybe the knee-jerk disappointment from Microsoft to maybe some of the chip names. I think that's misplaced. I think this is really just the start of what I view as sort of fourth industrial revolution, almost AI gold rush playing out, $1 trillion of incremental spend. And I just hit back at clients, from everything we see, next year it's 8 to 10% of budgets in terms of AI versus less than 1% today. That I view is really going to be the catalyst for this tech, what I view is really the new tech bull market that's already begun to continue well into 2024.
Where have markets, or what have markets missed? Because NVIDIA we have all seen, and everyone's impressed, and I think everyone, even Paul, has bought some. What have we overlooked?
Well, I think what's markets may be missing in the near term is just what a catalyst this is going to be for software. I think really it's the software. When I look at names like Salesforce, MongoDB, you look at AI names like Palantir, I think it's the second, third, fourth derivatives that maybe markets missing out here and just maybe underestimating it, because I believe this is a 1995 moment, start of the internet, not a 1999, 2000 moment. I think that dynamic is why we see tech stocks up 15% second half of the year.
Dan, you mentioned Palantir, and I know you recently initiated coverage there. Not a lot of people know what Palantir is. Give us just a quick description of what Palantir is and why you like this name.
Yeah, and that's one, CARP created Palantir really coming out of the government. If you look at where their success has been, that really machine learning is who they are. And now it's happening from a use case perspective. They probably have the most robust pure play AI platform and use cases out there. So you're seeing that across enterprise, across government. I look at it as a pure play AI play. Of course, NVIDIA, Microsoft, Google, MongoDB, among others. But this is really front and center. I think it's an undiscovered gem, in my opinion, relative to the broader AI trend.
Let's get to Tesla. I want to ask you about the price cuts in China. Paul brought this up already. Weren't they supposed to stop doing that?
Yeah, look, we've said that here and there you could see some price cuts, but this only impacts, 15% of when you look at Model Ys impacted. It's really around the edges. I mean, mostly you're really not seeing price cuts across in China. Now, of course, headline, it's going to look negative. But if I look from a demand perspective, China continues to be strong. I think on track for 1.8, potentially higher in terms of million units for the year. And right now, they are just, I view this as almost halftime of the Super Bowl.
But they're
just gearing up.
But does this kick off another price war, Dan, in China?
I don't think so, because Matt, we've talked. I mean, all the work that we've done the last 2-3 weeks, we think 95% of the price cuts are basically done in China in terms of that price war. I don't see this igniting the next stage of the price war, which is why we're buyers here on weakness. I think this is bark worse than bite.
Hey, Dan, I was just looking at the PGEO function on the Bloomberg terminal, which gives you a breakdown of the company's businesses by measure, by geography, by segment. And I'm looking at the by geography, and China's now up to more than 20% of revenue for Tesla. How does Tesla manage its relationship with such an important market like China? How do they manage it?
I mean, they take a page out of the playbook from Cook and Apple, because it's 10% political, 90% business. But ultimately, I mean, if you look at President Xi and in China, they look at having Tesla in terms of Giga, Shanghai, potentially a second factory as well. That's a trophy case in terms of having Tesla as well as Apple there. It's a major part of production, a major part of demand. It's the hearts and lungs of the story. And that's been that tightrope, that balancing act, has been one of the key successes that Musk has been able to navigate, despite many worrying about the geopolitical. And I think they continue to gain share there along with Apple. And I think that's a story that's going to continue to play out.
But to what extent do investors, or do you view their exposure to China as a meaningful risk?
I view it as a background noise headline risk. I think they've been able to navigate that well. I think maybe some of the risk, the most of that was probably in the rearview mirror. That's still going to, for here and there, just given the geopolitical. But, we view that more as an opportunity than a risk for the likes of Tesla and Apple. And that continues to be our view of China in terms of those stories.
Just want to ask about the competition you see from GM and Ford. I was over looking at Cadillac's new Escalade IQ, which is awesome but expensive. So it's not going to compete really with anything Tesla makes other than, I guess, the X. I don't think that would be a fair fight. But are the incumbent automakers going to really bring it to Tesla in terms of affordable electric vehicles?
Well, that's the key. I mean, if you look what's coming out of 313 area code, more affordable EVs. I think what Farley's doing at Ford, what Mary's doing at GM, I think it's the right strategy. And it's not a zero-sum game. I think they are going to really transform those companies in terms of Ford and GM. But Tesla, in terms of electric vehicles, it's still Tesla's world. Everyone else is paying rent. And I think this is just start of this green tidal wave, $5 trillion green tidal wave that's really going to transform autos across the board, from Tesla to 313 area code to Europe and, of course, China.
Hey, Dan, thanks so much for joining us. Really appreciate you taking a few minutes out of your holiday. Dan Ives from Crete. He's a managing director, senior equity analyst at Wedbush Securities. I don't know, that water behind him, is that the Aegean Sea or the Mediterranean? I mean, there's both over there. I don't know what's what.
Guess that's the Med.
Yeah. Both of them are pretty good.
It's a completely random guess, and I have no way of
I'm
telling.
looking at my Google Maps here. It could be either. I don't know where one starts, the other one begins.
I just don't see a lot
but
of
Crete,
swells.
right off, I guess, the southern coast there of Greece, part of Greece, largest island and vacation spot in Greece. How about that? So Dan Ives over there getting a little R&R. Good for him. Right now, with our news in New York City, here is Michael Barr.
Paul, Matt, thank you very much. 10:33 on Wall Street, live from the Bloomberg Interactive Broker Studios. I'm Michael Barr. Some of the stories we're watching this morning. At least 96 people are now confirmed dead in the wildfire that swept through Lahaina on Maui. We're learning more about the heartbreak families are going through. Carol Hartley lived with her boyfriend in Lahaina. Her sister, Donna, says they know Carol is gone. Her boyfriend found her body.
And he found her watch laying down on the ground. And he said it was hers. And that's what she's been wearing a long time.
The list of those unaccounted for has hundreds of names on it. A fourth indictment against former President Donald Trump may be imminent this time in Georgia. Fulton County Prosecutor Fonnie Willis is expected to present her case to a grand jury this week. An outsider congressman pulls off a primary upset in Argentina's presidential race. More from Bloomberg's Steve Rappaport.
Javier Milei garnered more votes than both opposition candidates combined, as well as the ruling bloc of economy minister Sergio Massa. Milei is often compared to former President Donald Trump, declaring in his victory speech that politicians are not the solution, they are the problem. Argentine assets are likely to sell off today as investors fear Milei's proposals, including the dollarization of the economy, will trigger financial unrest. Whichever candidate makes it to the finish line in October will have to spring into action with a plan to cut spending and stave off hyperinflation. Steve Rappaport, Bloomberg Radio.
Los Angeles police are searching this morning for around 30 suspects they say took around $100,000 in luxury goods from a local Nordstrom store over the weekend. It worries law enforcement that these flash mob smash and grab robberies are on the rise in the area. And researchers are reporting an increase in cases of leprosy in the U.S., especially in the Southeast. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. I'm Amy Morris with your Bloomberg Business Flash. Economists at Goldman Sachs predict the Federal Reserve will lower interest rates by the next June and put the brakes on rate hikes for the rest of this year. Bloomberg's Valerie Teitel puts it in context for
Now,
us.
the interesting thing about this Goldman note is their call for cuts isn't necessarily alongside a bearish view on U.S. economic growth. It's all just about the Fed wanting to normalize rates because inflation is falling back to target, right? And I think what prompted this call from Goldman was that weak inflation print we got last week, where we saw the month-on-month figures really just being a second month in a row in line with the Fed's target, only rising 0.2% month-on-month, which if you annualize that, it gets us to the Fed's 2% goal.
Bloomberg's Valerie Teitel says Goldman predicts the Fed will start cutting rates by 1/4 of a point next summer. We check markets all day long right here on Bloomberg Radio. The Dow is little changed, down 2 points. S&P 500 down, a gain for S&P 500 now, up 0.3% or 13 points. NASDAQ up 0.5% or 69 points. The yield on the 10-year Treasury at 4.18%, and COMEX gold now at $1,942.10 an ounce. That's a drop of $4.40 or 0.2%. I'm Amy Morris. That is your Bloomberg Business Flash. Now, Paul and Matt.
All right, thank you very much, Amy Morris. We appreciate that. So, Matt, the real yield. So this is a nominal yield on the 10-year Treasury, like 4.2%. Then you back out the inflation measure. Right now, it's at, looking on the terminal, which you just gave me, the ticker USGGT10Y, blah, blah, blah. Gets you to 1.8%.
Yeah.
So we've got a positive real yield in the United States. What does that mean? Well, I'm going to ask somebody who does this stuff for a living. Ethan Devitt, Chief Investment Officer for Moneta Group here. So, Ethan, thanks so much for joining us. We've got yields going higher, and I'm looking at the real yield. That's positive. What do you make of the yield space here and kind of what it means for broader markets?
It's a really interesting conundrum, and I think one of your columnists actually wrote about this pushing of the 10-year beyond 4%. What's driving it? Is it a sense that the economy is so resilient that it's really now firing on all cylinders? The Fed won't have to do anything in terms of cutting rates, and that that soft landing is already in the rearview mirror, and we're still in a very robust state. Is it a sign that investors are going to look at bonds as this alternative to equities? There's been no yield in cash for so long, very low yield in bonds, and now that there is this yield in bonds, will this represent a nice alternative to equities? I don't think we're going to see a big sea change in moves into bonds. I think bonds are a core part of a portfolio. Even at this real yield you mentioned, they're still pretty modest in terms of a contribution to a portfolio return compared to equities. And remember, we're in an environment where equities are up double digits, more so in the tech space.
So what we did see, at the beginning of the year, we saw some real flows into fixed income, right? That kind of turned around, and in terms of the ETF flows, it seems like they came late to every party. How does this strengthen the currency? Do investors around the world say, hey, there's a real yield there. Looks like they're going to avoid a recession that Europe is definitely going to hit, and China is sort of stuck in some kind of malaise here. We have to buy that currency.
It certainly is a good support for the dollar, but I'd say if the Fed is pausing or not likely to continue to raise rates and other central banks are not yet done, that will increase the relative attractiveness of those currencies. We have seen a weaker dollar this year, not notably so. It's not notably down from its peak that we saw, this 20-year high. It was at around the end of last year. So I'd say this fear of de-dollarization is subsiding somewhat, particularly as we see these problems in China. If China was seen as a viable alternative for a currency of last resort for a safety trade, I'd say that argument is looking increasingly frail today. So the US, with its strong components of technology and the equity market, is a very attractive option for those looking for exposure to this cycle right now. So I'd say the US dollar and the US will be supported. Not a great deal of weakness coming, but equally nothing driving it higher.
Ethan, your former colleagues at Goldman Sachs, they came out over the weekend saying, hey, we might get a rate cut in the second quarter of 2024. What do you make of that call?
Well, it's interesting because they've been pushing out. They were one of the first groups to not have a recession in their estimates, at least to move away from that. And Canada's been kicked further down the road. A rate cut seems even early. We would need to see quite a significant deterioration of sentiment between now and the second quarter, which is really only about 3 quarters away at this point. So I don't see what would drive necessarily a pivot like that from now still rising climate to a pause to a cut. We'd have to see something quite significant, maybe along the lines of another banking crisis. Certainly, while this large number of funds are in money market funds, and the money market fund level is well above 5 trillion now, that's a lot of cash, a lot of dry powder sitting on the sidelines that can come in to shore up markets, and above all is shoring up the consumer. So it would have to be something pretty catastrophic to push us into a rate cut environment in 9 months' time.
It's interesting. Goldman Sachs has forecast 1 cut every quarter for next year now.
Nice.
And I've heard that
as someone who's holding a mortgage and was looking to refinance said mortgage.
I've heard that from a couple of shops on the street now. It seems to be sliding into consensus, and it's not far off what the dots have, right, Ethan?
Exactly. Well, the consensus was uniformly, I'd say, wrong when it came to the recession occurring in 2023. We've had this inverted yield curve. We then saw it migrate around a soft landing. So I'm not sure if the consensus is necessarily to be believed at this stage. Has it been a little bit behind the curve? Has it been trying to superimpose structures and market behaviors of past recessions onto this one? And there are a number of reasons why this so-called recession that's been pushed down the road is quite different in its makeup. So I'm a little bit wary of looking to history and past behavior around rate rises in order to inform what's likely to happen now.
Fair enough. Why do you think the dot plot, though, has the same priced in? I mean, does that mean that somebody at the Fed expects maybe a banking crisis? Does that mean somebody at the Fed expects unemployment to rise to 4.5%, 5%? Does that mean, or do you think they just figure, rates go up, they're going to come down over time as well, and they put in those points?
We're really in the era of the unknown, the uncharted territory at this point, even if there is a dot plot to chart it, because there hasn't been a rate rise hike of this significance and short time frame. Recently, we don't necessarily know how that's going to play out. I think the Fed expects the transmission effect of that rate rise to have long and lasting effects. So if there was a sense up to a few months ago that only about 25% of those rate hikes had made their way into the economy in terms of impacting the consumer, many of whom have locked up their mortgage rates probably at lower rates that then those looking to refinance soon and lock them up for a long time. So the transmission effect is not clear. So for that reason, perhaps the Fed thinks there's more impact to come of rising rates, more pain to come, more crimping of consumer behavior, and perhaps more unemployment to follow. I don't happen to agree with that, but that would be the situation playing out as the textbooks would suggest.
How many marathons have you run, Ethan?
I'm at 51 and counting. It's Philadelphia next in November.
Which one next?
Philadelphia.
Okay, one simple question. Why?
It's a psychological journey. It's a festival. I'm at an age where I don't get to go to many music festivals. So going to a running festival is the next best thing. It's a great atmosphere in the streets. My last one was Boston. Absolutely electric. It's great to have the streets closed down, the music playing, and just that sheer spirit lifting us all. I think it's fantastic. I would do more, but probably my body needs to say stop.
What has been your favorite one to date?
I'd have to say New York City, which was my first, 1996. But equally, the one I just did in Boston was an amazing triumph because it was raining, and I managed to beat my last time, the time I'd been hovering at for most of 22. I took about 20 minutes off that time in Boston in April of this year. So that feels pretty triumphant.
Very amazing. Good. Whenever I see people running, I'm like, where are they going?
I just don't understand. Do other people not have the same knees that I do? It would be It would not be possible for me to run that many miles.
No, why would you even think? I mean, get a perfectly good, Vespa scooter. You can get there faster. Ethan Devitt, we appreciate getting some time from Ethan. She's Chief Investment Officer for Moneta Group and running just like all these marathons. I have no idea why, and I just can't get into it. But they're fun to watch to see these people.
Oh, I would do it if I could. If my body could take it, I would do it. For sure.
But I mean, and Lisa's laughing at us back there.
She probably runs
because she's a
marathons, too.
beast.
Yeah.
So yeah. So anyway, we'll have more coming up. This is Bloomberg. All right, let's get some company news from Lisa Mateo.
Yeah, I've only run one, so there you go. Well, PayPal, some news here. It's named a new CEO. CNBC cites members of the board selection committee who says Alex Chris will take over the role starting September 27th. And PayPal's Dan Schulman will remain as director. Shares of PayPal right now up about 2%. And Apple is planning a major overhaul of its smartwatch, but you won't see it this year. Bloomberg's Gina Cervetti has more.
Bloomberg tech writer Mark Gurman says the Apple Watch 9 models due next month will see minor upgrades, but expect more dramatic changes for the 10th anniversary model. He says designers are working on a thinner case and looking at changes to the way the band attaches to the watch. Apple introduced its smartwatch in 2014 and released it the following year.
Now, the 10 models may launch in either 2024 or 2025. Shares of Apple right now up just a fraction. And Sony Music and 5 other labels want almost $400 million from the nonprofit Internet Archive. They say the posting of thousands of old songs and recordings online amounts to wholesale theft of copyright-protected music. Bloomberg's Steve Podis reports.
Among the artists cited, Frank Sinatra, Billie Holiday, Louis Armstrong, and Thelonious Monk. The archive maintains a digital collection of text, video, and music online.
And finally, shares of Hawaiian Electric Industries plunging down almost 40% over worries that its power lines may be linked to the deadly Maui wildfires. Hawaiian Electric being criticized for not turning off power despite weather forecasters warning that dry conditions could create fire conditions. Those are the company stories we're following. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney here in our Bloomberg Interactive Broker Studio. A little bit of green here on the screen. S&P 500 up about 0.5%. NASDAQ up 0.8%. So we'll take that. Calling out the dollar here again today. The Bloomberg Dollar Index up about 0.3%. Yield front, let's make a note here. We've got some moves here. 10-year Treasury up 2 basis points, 4.17% on your 10-year, 2 years. 4.94, so back on that 5% watch here. So we'll keep an eye on that. WTI crude oil off just a little bit, $82.80. Right now, with our news in New York City, here's Michael Barr.
Paul, Matt, thank you very much. It's approaching 10:56 on Wall Street. The wildfires in Maui are now blamed for at least 96 deaths. More from Bloomberg's Steve Rappaport.
The wildfires that reduced homes and livelihoods to piles of ash are the deadliest for the U.S. in more than a century. Governor Josh Green describing the trail of destruction.
The devastation is so complete that you see metals twisted in ways that you can't imagine. And you see nothing from organic structures left whatsoever.
Green says early estimates put losses near $6 billion. Meanwhile, the disaster is prompting questions and concerns about the effectiveness of an emergency alarm system. Lawmakers want to know why the system failed to alert people in Lahaina before their town went up in flames. Steve Rappaport, Bloomberg Radio.
Former President Donald Trump could, in a matter of days, be indicted for a fourth time this week. This morning, there is an increased security presence outside the Fulton County Courthouse in Georgia. District Attorney Fani Willis says if someone broke the law in Fulton County, she has a duty to prosecute. Public schools in Louisville, Kentucky remain closed because of a school bus mess. Some children were never picked up while others didn't get home until 10 p.m. last Wednesday, the first day of school in the state's biggest school system. Many parents are upset. State Representative Tina Banjukowski.
Parents need to have their voice heard. They are the most important stakeholder in our school system.
Louisville school administrators came up with new school bus routes and school start times because of a shortage of bus drivers. A human rights group is urging the international community to move more quickly to intervene in ending Haiti's gang violence. Human Rights Watch says the longer we wait, the more Haitians will be killed. It requested the UN Security Council immediately deploy an international force to deal with the surge in violence. Gangs are said to now control at least 80% of the Haitian capital. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Michael Barr. This is Bloomberg. Paul, Matt.
Hey, Michael Barr, thank you so much. We appreciate it. Matt, let's talk weed, and let's talk weed in someplace close to home for you, Ohio, because it looks...
The great state of Ohio is and will forever be my home.
Absolutely. Ohio looks to vote on the legislation of recreational marijuana in November in a move that could improve the legislative and financial prospects for the cannabis industry worldwide. More Midwestern weed could help the cannabis companies nationally because, again, we don't have a federal weed law. We're going state by state here.
Yes, and 23 states have already made marijuana legal recreationally, right? More have made it legal medically. In Ohio, it's already legal medically, so you can go and get a card and then to a dispensary if you feel like visiting a doctor. The interesting thing, I think, the most interesting thing I think about this is because Ohio's not huge, right? There's 12 million people there, so it's not going to push the marijuana industry over the top.
But how many presidents have come from Ohio?
8 presidents have come from Ohio, the most.
So if you're like in
of any
kindergarten in Ohio, that's what they teach you, right?
For sure. Yeah, that's where you start out. The cool thing though is that we also have Senator Sherrod Brown, a Democrat from Ohio, who is the chairman of the Senate Banking Committee.
Okay,
and that is important.
That's the big one
because if weed is legal in his home state, then it'll be much easier for him to push through the Safe Banking Act.
What does the Safe Banking Act do?
Will allow weed companies or people working in the industry to move money through legal banking channels, which they currently can't.
And that hinders this development of this industry big
Absolutely.
time. All right, so I guess all weed eyes are on Ohio as we speak. Who would have thunk it? But again, Ohio, the great state. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to get the latest from Argentina. Got big moves in the markets there based upon some surprising political developments there. We'll get the latest reporting. Plus, we're going to check in with Tom Orlik, chief economist with Bloomberg Economics, on what is happening in China, some of the economic and financial news coming out of China. Tom worked and lived in Beijing for years. He's got a great view of what's happening there. Plus, Matt Siegel, head of digital asset research at Van Eck Associates, he's going to join us in studio to discuss the first SEC deadline to approve or disapprove BlackRock's Bitcoin ETF, which is a critical milestone for our folks looking at the Bitcoin space. But first, let's get some news with Amy Mars.
All right. Thank you, Paula. We do want to take a look at China, a bit of a preview of your interview, which is coming up. They're moving to address a property slump that continues to deteriorate. We spoke with Bloomberg China economy editor James Mager in Beijing.
If you pull back and look, it really is the housing sector that is underlying a lot of the problems that China is seeing.
Bloomberg's James Mager was a guest on Bloomberg Daybreak. Renewed concerns about that property sector, missed payments by one of the nation's largest private wealth managers, unprecedented losses at China-focused hedge funds, the threat of deflation, all of that combining to deal a blow to investor sentiment. We check the markets all day long right here on Bloomberg Radio. Dow little change, down 9 points. S&P 500 now up 0.4% or 17 points. NASDAQ up 0.7% or 97 points. The yield on the 10-year Treasury at 4.17%. The 2-year yield at 4.94%. NYMEX crude oil trading at $82.68 a barrel, down 50 cents or 0.6%. Brent crude down 0.7% or 61 cents, now trading at $86.20 a barrel. COMEX gold at $1,940.80 per ounce. That's down $5.80 or 0.3%. I'm Amy Morris. That's your Bloomberg Business Flash. Matt and Paul.
All right, Amy Morris, thank you so much. We appreciate that. Lots going on today, Matt, in kind of just geopolitics around the world. Argentina, they had a primary vote. I guess a populist-leaning person.
Not just any populist. He looks like a cross between Elvis Presley and Johnny Cash.
Nice.
Maybe throw a little James Spader in there. He has, I think, 5 or 6 giant dogs,
Nice.
each one named after a different Austrian economist.
Really?
Or,
Well, you're
I
just
mean,
a
like
fount of knowledge.
liberal free market economist.
Okay.
One of them's called Milton Friedman, I know from the Bloomberg story. And, I mean, there's such a great story on the terminal that if you haven't read it, I highly recommend going to Bloomberg.com on the computer or on your terminal and checking it out, because it's really good.
And we've got big moves in the currencies and the bonds and the government bonds there in Argentina as well. So let's get the latest reporting there. Manuela Tobias, she joins us. She's the economy and government reporter for Bloomberg News. Manuela, let's just start off by just reframing what happened in this primary and what has been the reaction in Argentina. Manuela is in Buenos Aires today.
Hey, yeah, so yesterday was just a complete upset. Javier Milei, the economist you guys have been talking about, outsider presidential bid, was not expected to get more than 20% in this three-way race. There was the incumbent, the main opposition bloc that everyone saw as winning, and the question mark was around, what kind of margin they would beat the incumbent by. And then Milei just completely surprised everyone and got 30% of the vote, becoming the most voted candidate as well as the most voted bloc. And that just sent everyone into panic mode. No one was expecting this on the political side, and much less on the market side. This was the least likely scenario, and definitely the one that was going to see the most panic, and that's exactly what we're seeing today. The central bank just raised its key rate from the already very high 97% to 118, and devalued the peso, which was trading at it's an officially set rate from 287 to 350 today.
I love the quote from your story, Manuela. He says, "Remember, a different Argentina is impossible with the same people as always, with the same people that have always failed." You got to get rid of all that old blood, right? I mean, does he really want to throw out everybody who's been there? Well, does he really want to start a revolution here?
That is that's his proposal, and that's exactly why people support him. You know, talking to his voters, this was very much a question mark election. No one knew what was coming, and all the pollsters described it as one with high levels of apathy among voters. I mean, we have inflation running at 116%. Nearly 40% of the population is below the poverty line. Things are pretty desperate here, and you need the thinking among his voters, which who turned out in droves, is you need someone just as crazy as the situation that we're experiencing to get us out of this mess. And that was his campaign message. He said, "I'm gonna blow it all up." In fact, during his the campaign closing event, to get his fans riled up before coming on stage, he had videos of buildings blowing up, literally, and people going crazy in the crowd, before he came on and just started singing his theme song. And his big mantra is "Viva la libertad, carajo."
So
yeah.
Wait, what is that? What's the translation of that?
It basically means sorry, I'm trying to translate in my head now. We have it on the lead of the story. It's
we'll get to that.
"Let's go liberty, damn it."
Right.
Oh,
exactly.
I see. "Long live freedom, damn it."
Yep, exactly.
Is the translation.
All right. So Manuela, what's the next steps here in Argentina on this political process?
So this was a primary election, very different from the primaries you guys are probably used to, where there's different parties have their own votes. This is kind of like a general, because all the candidates are on the ballot, and polls, as we just went over, are completely unreliable. And so this was kind of a thermometer of what's to come in the general. This knocked out one of the two candidates in the pro-market business coalition, and left the incumbent party pretty knocked down. It's a historically poor election for the Peronist left-wing party. So what this means is we have an October election coming up. That's a general. In order to win that election, the winning candidate needs to get 45% of the vote, or 40% with a 10 percentage point, 10 points above, the runner-up.
Right.
If we don't get to that, which is looking increasingly likely with, this race literally divided in three, we could go to a runoff, which would come in November. So uncertainty is certainly the
so
the,
just
the ruling.
Just to circle back to Javier Milei here, in the story we say that he's kind of radical with some far out ideas, and I think the term crazy was thrown in there, but his dog's named Milton Friedman. So for those of us in this country, Manuela, Milton Friedman is a pretty sound thinking free market capitalist economist. Like, what's the crazy part of Milei's propositions here? Because it seems like I don't see anything that far out there for us. Yeah.
Of course. Okay, so that, I think that's part of the nuance here, is that his reforms, the policy ideas that he has, which is cutting public spending. In fact, he says bringing a chainsaw to public spending. These are the kind of ideas that market support, that the pro-business coalition is proposing. But he has a certain eccentricity to him. Right. We're talking about his dog. This dog, he refers to him as his son. Oh, and then the four kids that this dog had are his grandkids. That oldest dog died, and he actually had it cloned. He had another dog, and was talking about him.
Right, so I thought things were
I'm totally understanding all of this.
I know. So, all right, Manuel, you got a lot going on down there. We're gonna look forward to some more reporting down there, but a big surprise in the primary election down there, which is roiling the financial markets down in Argentina. Manuela Tobias, she's the economy and government reporter, joining us from
Buenos Aires.
Buenos Aires, thank you very much, from Bloomberg News. All right, let's switch gears, go from one geopolitical hotspot to another, that being China. We got a lot of economic data coming out of China, which was, or not economic data, but more just some financial data going on about the economy and some of the businesses there. Tom Orlik joins us, chief economist and chief Asia economist for Bloomberg Economics. Tom, you lived and worked in Beijing for years. You know what's going on there. I think 2023, people went into saying, this is going to be a good year for China. The economy's reopening. It's going to be a good year for China. It's not turning out to be that way. What are some of the key headwinds that we've been reading about in the last couple of days?
So the really big challenge for China's economy this year, Paul, is what's happening in real estate. Real estate is a critically important driver of China's economic growth. It's also where households have most of their wealth. Chinese households, they haven't got a lot in stocks, they haven't got a lot in bonds, it's all in their houses. And what's happening right now is there's just been massive overbuilding in the real estate sector. And as a consequence of that, we're now seeing property sales falling, property investment falling, and property prices, especially in some smaller cities, falling. Now, that was already part of the narrative in 2022. What's happening in 2023 is it's getting worse. We've now got news that Country Garden, one of China's biggest property developers, is struggling to repay its debt. And we've got some alarming signs that this is now tipping over into the financial sector. One of China's biggest trust companies struggling to make its investors whole.
So what happens here? I mean, if one of their biggest trust companies starts defaulting on payments, doesn't the government just come in, take it over, and make those payments in lieu of the failed company?
So the strength that China still has is that the savings rate within China is really high. It's hard to take money out of the country. And if you look at not the shadow banking system, not the shadow banks like the trusts, but the banking system proper, it's all owned by the government. And what that means is that China's government has a lot of tools they can use to prevent real estate stress, even extreme real estate stress, tipping over into a financial crisis. The question is, where do they draw the line, right? A trust company, even a really big trust company, is not what you would consider a core part of China's financial system. If a trust company goes down, some rich investors are going to lose some money. It's going to be a bit painful for sort of that group, but it's not going to be a trigger for a systemic crisis. The question for Beijing in the days and weeks ahead is, are they okay with big trust companies going down? If big trust companies go down, are they okay with small banks going down? If small banks go down, are they okay with city banks going down? Where do they draw the line? My instinct is the trusts, the shadow banks, they might have to get through this on their own. When we start to see problems trickling into the banking system, even the smaller city-level banks, that's where Beijing steps in.
So, Tom, how much of a political headwind is this for President Xi, who just recently secured another, I don't know, I guess 5-year term, if not more? How much of an issue is this for him politically?
So China does not have elections, but China does have politics. And if you're in charge of an economy with a youth unemployment rate of 20% and with prices for housing, which is where most Chinese people have stored their wealth, either flat or falling, then you've got a political problem. How does that play out in a single party state? Well, the first thing to say is it plays out behind the scenes, right? If Xi's hand is weakened, that's going to be something which is evident to people in the backroom deals in Beijing. It's not going to be so evident to us here in the United States. Still, that additional political stress is an additional constraint on policymakers' room for maneuver.
Tom, I know there's not an easy fix here, but is there a solution that a lot of economists like yourself see there? Or is this just something that the Chinese economy is going to have to deal with for a long time and let it play out?
So there's a big structural problem here, right? China has massively overbuilt its real estate sector, and that means there isn't an easy fix. There just has to be a period where real estate construction, real estate prices come down in order to realign supply and demand. There's no getting away from that. Now, what does a big fix, a kind of grand solution look like? Well, firstly, it's a grand solution which doesn't make things better. It's a grand solution which stops things tipping over into catastrophe. What are the moving parts of it? Well, I think it has to combine an element of reform, an element of increased transparency, an element of increased market control, so investors think that the underlying problems here aren't going to repeat, and an element of stimulus, more significant stimulus than the government has so far been willing to put on the table.
And that's we still expect that base case that China's going to stimulate the economy?
So they're drip feeding the stimulus, right? Yeah. We've had a mini rate cut by the PBOC. We've had the PBOC guiding banks to move mortgage rates lower. We've had Li Qiang, the premier, saying to China's cities, okay, we want you to reignite the property sector. We want you to stoke the healthy development of the property sector. They need to do more.
All right, Tom, thank you very much for taking a few minutes. Tom Orlik, he's the chief economist for Bloomberg Economics. He's also author of the book, Understanding China's Economic Indicators and China, the Bubble That Never Pops. So he lived and worked in Beijing for many years, so he's got excellent perspective there. We appreciate getting a few minutes of his time. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it. Nikola is recalling more than 200 of its battery-powered electric commercial trucks and pausing its sales. And this after a defective battery part allegedly caught fire. Bloomberg's Katie Greifeld has more on the stock's performance.
Today's plunge follows a pretty stellar run for the shares. Actually, if you look at the past 3 months into Friday's close, Nikola shares were higher by about 154%. But zooming out for the context, Nikola is down over 80% from its 2020 IPO.
And shares of Nikola right now down about 8%. It looks like unlimited paid time off is good for a company's stock price. Bloomberg's Kimberly Adams reports.
According to a Bloomberg survey, at least 64% of more than 1,000 respondents surveyed say companies that offer the option will do better than the S&P 500. Advocates of more flexible working arrangements believe the policy allows employers to attract top talent while also helping cut costs associated with compensation for unused vacation.
Now, Microsoft, Adobe, Netflix, they are all among the few companies that are offering that perk. And PayPal has named a new CEO. CNBC cites members of the board selection committee who say Alex Chriss will take over the role starting September 27th. And PayPal's Dan Schulman will remain as director. Shares of PayPal right now, well, they're up about 2%. Another milestone for the Barbie movie. Yeah, you guessed it. The film not only topped the North American box office for a 4th straight weekend, but it also crossed the $500 million mark domestically. Shares of Warner Brothers right now down about 1.5%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
$11.21 on Wall Street. Hawaiian Electric Industries plunged on concerns that those power lines may be linked to those deadly Maui wildfires. Shares of Hawaiian Electric now down nearly 37%. We check markets all day long here at Bloomberg. Dow Jones unchanged, down 1 point. S&P 500 up 0.3% or 14 points. NASDAQ up 0.5% or 77 points. The yield on the 10-year Treasury, 4.16%. The 2-year yield at 4.93%. NYMEX crude oil now trading at $82.80 a barrel. That's down 37 cents or 0.4%. Brent crude down 0.5% or 45 cents. Now trading at $86.36 a barrel. COMEX gold at $1,942 an ounce. That's a drop of $4.60 or 0.2%. The euro at 1.0914 against the dollar. British pound at 1.2681. The yen at 145.33. I'm Amy Morris. That's your Bloomberg Business Flash. Matt and Paul.
All right, Amy Morris. Boy, you missed the discussion in here, but I don't know where we go with that. But Matt, why don't you bring in our next guest, and hopefully we can get this thing back on the track.
All right, so my old producer, Matt Siegel, is here. For a few ill-fated years, he worked at Bloomberg, but then he moved on. And is now covering crypto, running crypto coverage for Van Eck. And we're glad to have him here in the studio to talk about all things Bitcoin ETF, really, because on Friday, the 21 shares and ARK ETF proposal was punted by the SEC. They were due to decide, I think by today was the deadline, and they pushed that off. Now they've got even more Bitcoin proposals to decide on. One of them is BlackRock. So everybody is paying attention on the street. And Matt Siegel is the man to ask, what's going on at the SEC?
What's going on is it seems to be a political objection to a Bitcoin ETF, which is coming from the very top. President Biden, if you recall, January 2022, put out an executive order instructing all agencies to use kind of maximum levels of enforcement to bring this market to heel. And the arguments against a Bitcoin ETF have become increasingly haphazard and incoherent. And now there's a grayscale lawsuit against the SEC. We're expecting a decision any day on that, which could kind of reveal the illogical nature of the SEC's objections. But so, for now, it's a delay. No Bitcoin ETF for now.
So what proponents of the SEC will say, the concerns are around fraud and manipulation. And certainly there's no shortage of that in the crypto world. Not that there's any shortage of that in the plain vanilla Wall Street world. But you've seen some firms make moves to try and alleviate those concerns, right? Including with surveillance sharing agreements. Is that not far enough? Has it not gone far enough?
Let's start with the original objection, as you note, fraud and manipulation in the underlying market. Well, there are plenty of commodities like gold and silver and oil where the underlying commodity trading is not regulated, but once you wrap that commodity in a vehicle, like an ETF, then that vehicle needs to trade on a regulated exchange. So we don't think the SEC is being consistent in how they're applying that logic.
What's the basis, from your understanding, of this decision coming down from the top from President Biden about crypto? What is their side's fundamental